thrilled to introduce Vice Chairman Stanley Fischer. I've known for many, many years. I think maybe 45 or something like that. It's embarrassing. And I think of Stanley as a brilliantly serious economist and policymaker. In the early days, when he was just an economist, we had lots of interactions. And I remember one event, it was a time where we were trying to get engineers and economists to work together. We had a series of meetings to find, it's actually the concept was, if engineers know how to get us on the moon, they can help economists control the economy. It was a little weird. But Stan was, again, brilliantly serious, but one time he just brought the house down because he said, we've had these meetings about sharing ideas, and I've decided the economists have learned something fundamental from the engineers, and that's how to use an overhead projector. And believe it or not, before that, we were using blackboards and chalk, and the overhead projector was the big innovation, but it was terrific. But of course, other than academics, Stan has been chief economist of the World Bank, first deputy managing director of the IMF, governor of the Bank of Israel, now vice chairman of the Federal Reserve, and a little private sector in between. So it's a real pleasure to have you. Thank you for coming, and we look forward to your remarks.
Thanks very much, John. It's a pleasure to be at the Hoover Institution again. We throw big numbers around these days. It's 36 years since I spent a year here, and enjoyed it very much. And not only was it a pleasure being here because it brings back memories of the days I could run up to the dish, and many of the people here, but really many, are people with whom I've discussed monetary policy over the years, and and from whom I've learned a great deal. And I'd also like to congratulate John on many things. I remember when I commented on one of his papers at Brookings, telling the tale of I think he was 75 years old. We had a carpenter who was installing bookshelves in our house. And an old man, they told me he was very, I used to think it was old. He told me, people had told me he's really good at it, and you'd see this old guy show up in his truck, and the library, the place he was putting the bookshelves was up about 7 or 8 steps. He'd put this huge bookshelf on his back, climb up the stairs without any signs of effort, put the bookshelf in place, take a hammer, sort of tap it a few times, and the thing was there forever. And I said, watching John Taylor work is similar to that. Here's a guy who makes it look very simple, does it very, very neatly, doesn't show any signs of effort, and my God, it works. And there it is. So it's a pleasure to be with you again, John, although I miss you as I go running down the Potomac in Washington.
Yeah.
I'm going to talk today about I'm going to make some observations on monetary policy rules, observations you've heard many times from people in the Fed, and then talk about committees. So I have 2 messages. First, policymakers should consult the prescriptions of policy rules, but almost needless to say, they should avoid applying them mechanically. And I often think of rules as being a question of how much attention are you going to pay to them. You're sure you're going to pay attention to them? Are you going to go to the extent of being bound by them? And if so, for how long? And so forth. And rather than saying rules are good, implying you have to implement them, or bad, implying you don't, they're very good, very useful, and the question is just how much weight do they receive in your decisions? And second, policy-making committees have strengths that policy rules lack. In particular, they are a way of adjusting to new information and of aggregating a wide variety of a wide variety of information, and let me add a word, a wide variety of perspectives. You look around this room, there are a lot of perspectives on monetary policy, on rules, and what exactly monetary policy should be doing on a given day. And it's no accident that the Fed was set up with the type of committee it has, because the arguments in setting up the Fed related to what is going to be the influence of the bankers, i.e. New York, versus what is going to be the influence of the people who actually do the work, i.e. the rest of the country. And it was a tremendous argument. And if Woodrow Wilson hadn't been a newly elected president, it wouldn't have happened in a newly elected president with a lot of power in the Congress. It wouldn't have happened then, but it did. So let me start. I've considered monetary policy rules since May 2014 as a member of the FOMC, but my interest in them began many years ago and was actually among the earliest work and publications, work that I'd done and publications that I've had. At that time, the literature on monetary policy rules, especially in the United States, remained predominantly concerned with the money stock, or total bank reserves, rather than the short-term interest rate. Seen with the benefit of hindsight, that emphasis, that is on money rather than interest rates, probably derived from three sources. First, the quantity theory of money. If you're going to talk about inflation, well, the things we were told in our first class in economics, namely excess money growth causes inflation, made you think about discussing rules for money. Second, that research, early 70s, was carried out when monetarism was gaining increasing credibility in the profession. And third, there was a concern that interest rate rules might lead to price level indeterminacy, which is an issue that has since been disposed of by Bennett McCallum and others, although I heard it being discussed yesterday, I think, by John Cochrane. So it's still around, if not the main view. Subsequently, John Taylor's research, especially his famous 1993 paper, was a catalyst in changing the focus toward rules for the short-term interest rate, and his work thus helped shift the discussion in favor of rules for the instrument that central banks actually prefer to use. There's a footnote in this paper which says that when I was working together with Philip Cooper on monetary rules in the early 70s, it was true that when we presented that at a seminar where Franco Modigliani and Albert Ando were present, that they said, that's ridiculous. You have to look at interest rate rules. Money rules are not of any great interest. And I sort of listened and carried on doing stuff on money rules. John's 1993 study also did something very important. It highlighted the practical relevance of monetary policy rules, as he showed that a particular simple rule, the one that now bears his name, provided a good approximation to the behavior of the federal funds rate during the early Greenspan years. And the research literature on monetary policy rules has experienced a major revival since John's seminal paper, and it, of course, concentrates now on rules for the short-term interest rate. Consideration of interest rate rules has also come to have a prominent role in FOMC discussions, with the Taylor rule being one benchmark that we regularly consult. Now, I should make clear, John, that you face a conflict here. We think we discuss 5 or 6 Taylor rules at each meeting, but I've been told that you want the Taylor rule to be only the 1993 rule. So you have to decide on quantity versus quality and let us know what you think. So we say Taylor dates and so forth, but they're all derived from the same general approach. They're not exactly what you said, although one of them, Taylor 1999, exactly what you at least have written. But I'm going to build on recent remarks I've made elsewhere. I'll also indicate why policymakers might have good reasons for deviating from these rule benchmarks and why that could be appropriate. In particular, I point to reasons why the FOMC's discussions might lead to decisions that depart temporarily or permanently from the from the prescriptions of a baseline monetary policy rule. Now, some perspective on how policy rules are discussed in the FOMC is provided by considering what has changed over the past 20 years. Donald Cohen, at a landmark conference organized by John Taylor almost 30 years ago in January 1998, described the role played by monetary rules in the FOMC briefing process. His account noted that Federal Reserve staff members present FOMC participants with prescriptions from several policy rules, including the Taylor 1993 rule, and that remains true today. And if you didn't believe it then, the blue books and teal books, the books that the staff makes available to the FOMC participants before each meeting, demonstrate that the coverage of policy rules in the briefing material provided by the board staff expanded considerably in the years after 1998. Oh, it's 1998. I said 1988. Sorry. So it's only nearly 20 years ago. You can find those teal books on the the FOMC website, on the Fed website, and they're there up to 2011 because there's a 5-year lag in making our the transcripts of our work public. Don Cohen noted that policy rule prescriptions serve two functions: as a benchmark for the stance of policy. How does this compare with the Taylor rule or other rules? And second, to structure thinking about the implications of incoming information for the direction of policy action. These two functions continue to be important. Policy rule prescriptions provide a useful starting point for FOMC deliberations and a convenient way of organizing alternative arguments about the appropriate policy decision. Policy rule prescriptions, particularly those obtained from a dynamics model simulation, also help policymakers take to heart a key message of the literature on policy rules, namely that monetary policy decisions should concern the appropriate path for the policy instrument and not merely the current setting of that instrument. And of course, if you read the transcripts of FOMC discussions, you will see that much of the discussion is frequently about the future, about the path for the policy instrument. Cohen also observed, quote, that in truth only a few members look at this or similar information regularly, and the number does not seem to be growing. That state of affairs has probably changed in the 2 decades since Don wrote, and it's clear from the transcripts that rule prescriptions have frequently been cited and frequently are cited at FOMC meetings. And the prominence that interest rate rules have achieved in Federal Reserve policymakers' analysis of monetary policy was underscored by Janet Yellen in her speech at Stanford earlier this year. Further, as is clear from John's econometric derivation of his 1993 rule, actual policy decisions may and probably should exhibit systematic patterns that can be described as a rule. And in fact, as mentioned already, one attraction of John's rule was that it seemed to describe U.S. monetary policy decisions well over a certain period, and one that was associated with a reasonable degree of economic stability, one which many people began to think was bound to continue, but which, alas, has not continued. Nevertheless, central bankers who are aware of the merits of the argument for policy rules have on occasion deviated substantially from the prescriptions of standard policy rules. And further, while the implications of different monetary rules are described in the Teal book and typically referred to in presentations by several FOMC participants, the overall discussion in FOMC meetings is not generally cast in terms of how it relates to one version or another of the Taylor or any other rule. Another set of rules is mentioned frequently in FOMC discussions, and they are Vixelian, for it is often a discussion of R star, which in some formulations of the Taylor rule is also the constant term in John's rule. I have at this point to mention what the discussion is really about, and this concerns a conversation with one of our sons. The conversation is essentially about, are we going to leave the interest rate where it is? Are we going to raise it, or are we going to lower it? Well, there's a lot of discussion, but that's the subject. So once my son called me, had some problem relating to something in economics, and I said to him, he called on a Monday night, I said to him, I'm preparing for the FOMC meeting, can I call you on Wednesday? He said, Dad, I don't understand. You've been at the Fed 2 years. The interest rate hasn't changed by a basis point. What is it that you do there? As far as I can understand, you have three choices. You can raise the interest rate, leave it as it is, or reduce it. I said, that must take you 5 minutes. What do you do in the rest of the time? It kind of reminded me of an aunt of mine. I'm sure you all had aunts like this who ask you, what do you do as a professor? And you'd explain that sometimes you teach classes and so forth. And what about the rest of the time? Well, I had a feeling a bit like that. Anyway, the period since 2008 bears testimony to central bankers' willingness to depart from the prescriptions of a pre-specified rule. In the wake of the financial crisis, policymakers found it necessary to follow a more accommodative monetary policy that they judged was appropriate for the new economic conditions. And in addition, and this is probably a change that will last a while, structural changes in the US economy appear to have lowered the value of the interest rate of R star, consistent with a neutral policy. Now, if things happen that change the values of parameters, then you could expect that policymakers might just simply change the rule, and they might develop a procedure for revising the monetary rule. But a rule that is frequently revised doesn't really qualify as a rule in the sense that we currently use the term. When we're considering the relationship between monetary policy decisions and monetary policy rules, we can expect two regularities to hold. First, actual monetary policy will sometimes appropriately depart from the prescriptions of benchmark rules, even when those benchmarks describe past decisions well. And second, in their use of rules, policymakers will from time to time change their assessment of what rule they regard as the appropriate benchmark. Both regulations have been amply observed in recent years, but they were also present 20 years ago, as reflected in Cohn's remark that policymakers, quote, do not see their past actions as a very firm guide to current or future policy. Or as a teacher of mine at the London School of Economics, Richard Sayers, put it much earlier. This is an interesting article that he wrote. There's a reference to it in the references in the version of this paper that's on the Fed website. There is no code of eternal rules. We have central banks for the very reason there are no such rules. Namely, as everyone knows, if there was a rule that would hold forever, you would not need very large central banks, except if they were the bank regulator. That I think is true. But there's another factor, and that relates to the fact that monetary policy is made in most economies by committees. And At this point, I think I should mention the insightful paper by Kevin Warsh, which bears a 2016 date, but is actually at the 2015 conference, I think, and the discussion of it by Peter Fischer and others, including George Shultz, who I'm very, very delighted to see present at this event, that discusses aspects of committee decision-making that are likely to affect the quality of decisions reached by committees. And that was a paper that focused on the Fed and the Bank of England. And I would say that the comparisons were not entirely favorable in favor of the Fed's procedures, some of which stem from the fact that there are 19 people when the board is full sitting around the table, each of them with the right to say something, and at least 12 of them with their independent board of directors of their bank, which expects their guy to say something. So they're only doing what the board asks them to do. They're naturally not guys who want to talk, but they're forced into it. The fact that we're talking about that decisions are made in committees is not an incidental feature, and it affects many, many things. And I read in reading the discussion of Kevin Warsh's paper, I think it was John Cochrane who said how great the procedures are of appointing people at the University of Chicago. Well, when I was in the University of Chicago, they allowed the untenured assistant professors to take part in the meetings on tenure for other people. I thought that was pretty strange. And the strangeness was revealed when somebody opened his mouth and told the truth, an untenured guy. He said, look, I know if you appoint that guy, I'm not going to get tenure. How do you expect me to vote? And so I don't think the procedures at the University of Chicago were that terrific, Kevin. Anyway, policy rule prescriptions are more consistent with a single perspective on the economy than with the pooling of multiple perspectives that is associated with the committee policy-making process. And many of you must have read Roger Lowenstein's book, America's Bank, which describes how the founding of the Fed involved reconciling a large number of interests in the United States. And in similar vein, the modern FOMC framework, the modern framework dates from 1935, involves participation by 12 Reserve Bank presidents, each of whom represents a different district of the country. And the FOMC framework is also designed to balance the role of Washington and the role of the rest of the country, with Washington having 7 voting members when there are 7 members of the board. There are now 4, and the presidents having 5 voting members. Now, in principle, they all have a common goal: maximum employment and price stability, and those are given by our statutory mandate. And they've also agreed on a statement on longer-run goals and monetary policy strategy that describes, not in huge detail, but enough, what that statement means. But people bring different perspectives or views of the world to the meeting. Part of their role is to articulate that perspective and perhaps persuade their colleagues to revise their own perspectives, or vice versa. A member of a committee may well have important economic information not known by their colleagues until he or she relays it. This point is brought back to me each time I sit at an FOMC meeting and the presidents start with a description of what's happening in their district. And it's actually very interesting. And I have this terrible weakness. I sort of vaguely remember data, but I remember stories much better. And when somebody describes an event or something which gives you a sense of what's happening in their district, it makes more of an impression on me than another number relative to things, and I think that you do, at least I personally, do get a different perspective from different regions that I am forced to try and integrate into my head and integrate its relationship with whatever rule or whatever decision, whatever rule we use or whatever decision we're about to make. That means that the information underlying a policy decision is crucially shaped by a committee system. Committees can aggregate a large volume of diverse information about current and expected future economic conditions. And that, as I've just said, implies anecdotes and impressions gleaned from business and other contexts, which can provide insights that are not recorded in current data releases. We, of course, have the beige books, but it's not the same as hearing it come out of somebody's mouth and being able to say something to them and ask questions about that. I think this will leave the FOMC less inclined to follow a benchmark rule. For example, the committee's discussions might point to factors that have not yet affected real economic activity and inflation. And this couldn't statistically change a rule like the Taylor rule, because the prescription that the committee comes up with is probably more a function of current values, of the impression that people have about the output gap and future output gaps, and similarly for inflation. Now you can say, well, of course, if there's serial correlation, any rule that includes recent events is going to have serial correlation in it and will be taking account of the future. But you may have special information about the future which you would want to incorporate in your decision facing with respect to what's going to happen in coming months. And policymakers may also encounter unexpected or unusual events, or both, or they might perceive changes in the structure of the economy. A committee process is conducive to assessing the appropriate policy response to these developments. And a case in point is the decline in estimates of the neutral interest rate of R**. R* is a way of summarizing various forces, many of them unobservable, that shift the relationship between monetary policy and economic activity. Bringing diverse perspectives to the table is a pragmatic way of confronting such very deep sources of uncertainty, and they're very deep. There are things that are going on in a massive economy in many ways, in many different industries, and you've got to get them down to one number. And a committee discussion can flesh out the factors behind changes in the neutral rate, and a committee would likely be able to identify such changes more promptly than would a straightforward statistical exercise because of the wider set of information from around the country that the committee is able to process. Now, this decision-making environment means more flexibility for FOMC members than they would have if they simply followed a policy rule. Well, there's not entire flexibility because transparency and accountability must figure heavily in any more flexible environment. The FOMC's policy communications include its post-meeting statement, the minutes of its meetings, the chair's quarterly press conference, the chair's semi-annual monetary policy testimony to the Congress, and public remarks by individual FOMC members. And in this framework, policymakers articulate the reasoning behind each decision and in particular explain how the policy decision contributes to the achievement of the committee's statutory mandate. If I can insert a footnote, people complain about the cacophony that we get from having all the presidents speak. Well, there is a cacophony, but guess what? The cacophony represents views that are expressed in the board as well, and we've got to make something out of that cacophony and make a single decision. It's not that people can possibly, if you have a committee, people are unlikely, very unlikely, to walk around having the same view. It doesn't happen very much. And so, yeah, there's a cacophony and it's irritating, and this one thinks that and that one thinks this. But that's what they're there for, to say what they think and to describe why they think what they think. So I would find life much easier if there wasn't a cacophony, but there it is, and we've got to deal with it. Now, there's a deeper question about committee decision-making. Why have almost all countries decided that monetary policy decisions should be made by a committee rather than a rule? Well, there's a simple answer. Laws in most countries are passed by institutions in which committee deliberation is the norm, e.g. the Congress. But if that's the answer, then we have to ask why that has become a norm in almost all democracies for almost all collective decisions. And that is the way democracies have devolved, have resolved the divergences of view on important issues that serious people have, is by setting up committees and requiring committees to make decisions on particular dates or on particular issues. Because opinions differ among experts, democracies tend to prefer committees, which involve experts and in many cases other representatives of the public who discuss, try to persuade each other, and must at the end of their deliberations reach a decision. But, going back to the emphasis on transparency, those decisions have to be explained to the public and to other parts of the government, and hence the appropriate emphasis on transparency and accountability. That's the democratic way of making decisions when opinions differ, as they often do in the monetary field, and if you don't think they differ, look around this room and you'll realize that those differences have to be resolved when the committee makes a decision. I've been a governor of 2 central banks, and even as the sole monetary policy decision maker in the Bank of Israel, would sometimes find that my initial view on the next decision changed as a result of discussions with the informal advisory committee with whom I consulted at that time. Those discussions, which recognized human frailty in analyzing a situation and the need to act despite considerable uncertainties, are the reason why committee decision-making is, on average, and I emphasize on average, preferable to the use of a rule. Emphasis on a single rule as the basis for monetary policy implies that the truth has been found. It's very rare that the truth on issues like this is found. And in this case, that truth would have to transcend the record over time of major shifts in monetary policy, from the gold standard to the Bretton Woods fixed but changeable exchange rate rule, to Keynesian approaches, to monetary targeting, to the modern frameworks of inflation targeting, and the dual mandate of the Fed, and more. We should not make our monetary decisions, policy decisions, based on that assumption. Rather, we need our policymakers to be continually on the lookout for structural changes in the economy and for disturbances to the economy that come from hitherto unexpected sources. My view of decision-making when I was governor of the Bank of Israel was somewhere out there's some damn disturbance that is going to ruin the current plan, and it's my job to figure out what it is. Our job to figure out what it is. And it's probably coming from the back from behind me, not from there. And sometimes that was true, and often it isn't. But that's, I think, the right attitude to how we should think about policy and be ready to change what we want to do, what we think we should do. So let me sum up. The prescriptions of monetary policy rules play a prominent role in the FOMC's monetary policy deliberations, and I think our discussion would be different if we made the question, how much weight should be given to a particular policy rule in making your decision, rather than is it right or is it wrong? They're all going to be useful, almost all going to be useful, they're all going to be informative. You need to think about them. Should you implement them exactly? I think that will be rare. But in view of the usefulness of rules as a starting point for policy discussions, and the fact that comparison with a benchmark rule provides a useful means of articulating one's own preferred policy action, you have to look at the rules. But, and I'm summarizing now, adherence to a simple policy rule is not the most appropriate means of achieving macroeconomic goals. And there are very good reasons why monetary policy decisions are typically made in committees, whose structures allow them to assess the varying conditions of different regions and economic sectors, as well as to reflect different beliefs about the working of monetary policy. Thank you. So,
thank you very much, Stan. It's actually hit on one of the most important issues I can think of is how you have strategies or rules where committees are making decisions. And there's lots of questions, but I just want to just raise a quick one. Greenspan, when he was chair, said the Fed deserved an assist in creating the Taylor rule. And so there was a sense in which there are periods where there's more or less adherence to I'll use the word strategy. And so it's not impossible to think about committees coming to agreement on a strategy, even in a democracy. There are laws are passed. I'm not saying there should be a law one way or the other, but a law is a way to come to an agreement, and some people disagree, but there's compromises. So it's not impossible, and it sort of has some history. I'm not saying I agree 100%. You focused on a very key, important issue here, but it seems to me it's not impossible to put committee-making decision and rules-based policy together.
well, I think that's right. It's not impossible and can be done for a period of years. They always break down, and then you have to figure out what set of rules you're going to have for changing the rules. You know, in Canada they have inflation targeting, but every 5 years the central bank and the finance minister have to reach a fresh agreement on it. That's a way of dealing with the uncertainties. That's not impossible to envisage. But I think that we've gotten ourselves. Well, I'm always struck by one thing, John, and you'll excuse me explaining this to the crowd. When John and I have a conversation on monetary rules, I come out thinking, why the hell do we think, why do people argue about this issue? But then people do argue about this issue, and I think we've got to ask ourselves, what is the problem? And I think the problem is we're describing a rule as something which is a rule of the Medes and the Persians. It's never going to change. And we know it's going to change. And that, I think, is the emphasis that we haven't sort of placed on anything. So I can envisage, say, in the case of inflation targeting, a procedure in which you change the target or you change the other variables that are involved on some regular basis through some regular participation and as a regular calculation, a regularly undertaken calculation, and you say that's my rule. My rule is an equation at a moment of time combined with footnotes which tell you how to deal with special circumstances, and combined with another few paragraphs which tell you how to revise it over the course of time. That seems to me, if that's a rule, that sounds like a law. It's something that I could envisage.
Yeah. Okay, it's Bob Heller.
Thank you. I'm Bob Heller. Stan, you talked very eloquently about the advantages of the diversity of views that you get in the FOMC in the various opinions, and that really helps. Why do you think there's that enormous pressure of people to have unanimity in the FOMC? Why not have, like the Supreme Court does, you know, decisions 7-5 or 6 to whatever? So that would actually reflect the diversity that you so value?
I think the issue relates to the size of the committee and the need to drive it to a decision on a particular date. I mean, Mervyn King used to say that he wanted to be in the minority from time to time just to show that he could be in the minority and that the world didn't end that day, nor did the Bank of England break down on that particular day. Well, that's not been the tradition in the Fed. The tradition in the Fed goes the other way. And if you have a fair number of divergences of view, of dissents, you already start being in trouble as people who think very highly of Paul Volcker, but also know that in the end he had difficulty getting his decisions, some of his decisions through. The system could sort of tend to break down. What happens if there isn't somebody some group trying to drive decisions in a particular direction over the course of time? And many of the things, if you had if you had a very close to having two political parties in the 19 members of the board, I think you'd have a very bad monetary policy. And it's that need for some coherence to what comes out that pushes the Fed in the direction of preferring having few dissents. I mean, in preparing for this lecture, I read some of the stuff, a lot of it in papers and books, edited by or written by John Taylor. But the literature on what size committee is optimal says 5. I was chair of a committee of 6, which had originally been 7, and just to tell you about Israel, I thought, well, it'd be fine, so we'll have 4 outsiders and 3 insiders. So we put that in the law, and I sent it to the Treasury, and the head of the Treasury called me and said, listen, Stan, you're not in New Zealand. You're in Israel. If you don't start with some advantage, you're going to be outvoted very, very often. So we got down to 6 with a double vote for the chairman if there was a tie. So we had a small committee, but there was that characteristic. And then something very interesting happened, which relates to the Fed in some way. I never used the double vote, but somewhere near the end of my term, as the meeting progressed, I saw I was about to have to use the double vote for the first time. And then we had the vote, and whatever my view was, won 4-2. So after the meeting, I spoke to the guy who I had known for sure preferred the opposite decision, and said to him, why didn't you vote as I expected you to vote? He said, I thought this issue was too small for you to have to break the rule of not using the double vote. So that's when you see a committee trying to work as a committee and not as 6 different people. Now, there are questions about that. The principles set out for the Bank of England are everybody votes as a person and not as a member of a committee. And, I'm not sure what is better, because you've got to keep meeting, you've got to keep making decisions, and you've got to be able to speak freely if you're going to make good decisions. I don't know which way is the right way. On that particular day, I appreciated that guy's choice, but it wasn't critical in any way. It was just something about forming a group of people who make a decision.
George Shultz has a question.
You have a broad mandate, and you have certain specified tools. But it must be sometimes you see that the tools you have aren't enough to satisfy the mandate. Maybe you think tax policy should be different or spending policy should be different. To what degree do you feel a compulsion to speak up on behalf of your mandate to get other people to do what they should do?
Well, to answer your question, the answer is, at first thought, very often I'm tempted, and then I say to people around me, I'm going to go and say something this time. And they will say, you can't do that. And then I say, why not? And they explain to me why I can't do that. The last thing we need is a war with the Congress, for example. So in the end, I barely express my views. That was not the case in Israel, but it's a different culture. On the first day I was there, I said to a fairly large staff, what I don't want to hear from you is what you think my views are. And I really, if I find examples of that, I'll be very irritated. Well, I didn't suffer from that problem at all. They don't care. They just say what's on their mind, and that's a very attractive way that, to my mind, the society works. But it may only work in a small country, and I'm not sure it works in a very large country. Mike? Oh, sorry, you're in charge, John.
Stanley, my question is a corollary of George's. To what extent do, and to what extent should, the FOMC be taking into account the effect of their behavior on enabling fiscal policy that might be deleterious long-term? For example, enabling greater government debt issuance, long-term debt issuance, especially when the deleterious effects may be well outside what you're kind of looking at in the short-term determination monetary policy.
Yeah, Mike, I've thought about that often in having arguments with the European non-central bank officials about what they want the ECB to do. And I've decided I'm not going to play that game. I'm not going to be somebody who undertakes a policy that is not in my area, to influence something that is not in my area, that is the clearly defined responsibility of someone else, the finance minister or the government, as the case may be, because I will inevitably have to start lying at some stage if I'm going down that route. Why do you say this, Mr. Fischer? And then you'll start giving some story which is not exactly the true story. So I've decided that I told European policymakers, you're asking me to do your job. You're the finance minister. These are people who just talk to me, people I know. They're not people I've formally advised. You're the finance minister. You want a small budget. You want to have a small deficit. Well, go out and argue for it. I'm not going to go out and argue for it on your behalf through my actions. Well, it's a very tough point to get to, but I think that having to go out and play the other game is not one which which you'll be capable of doing for any length of time. I am sure that, Mike, that on some day there will be, and George, there will be things on which you say to yourself, damn it, I just have to say something. But the bar is very high and should be very, very high. It's not our job.
Andy Levin has a question. We got to wrap up soon.
So I really like Peter Fischer's proposal. I'm just curious if you would react to it. He's argued several times, including at this meeting a couple of years ago, that the central bank, at its organizational meeting every January, should adopt a quantitative strategy, a benchmark, a rule, if you like. It would indicate clearly to the public that it's going to follow that benchmark through the year. It explained to the Parliament or the Congress why it's adopted it, how it's relevant for the future and the past. It could be a Taylor rule or a variant of the Taylor rule or something else, but a quantitative strategy. It would solve the cacophony problem to a very large extent. It would be flexible because it could change it in future years, or if it works well, it could stick with it. So it seems so sensible to me, in which, of course, I think of Peter Fischer being very sensible. Why isn't that the right way forward?
Because I don't understand the logic of it. What is it? You can fix it for a year and change it. And in the middle of that, something happens that indicates that you left something out of your rule. That's what happens. You get into a crisis, you have to do something, and you do it. And you do things that are in your power. We don't have the capacity that the English have, the British have. They're still separate groups at the moment. That the British have, which is the central bank, the governor of the Bank of England can make a deal with the finance minister, with the chancellor of the exchequer, that will stick. I think a deal between the chairman of the Fed and the secretary of Treasury on something that is important will not stick. So we don't have such an easy capacity of flexibility with regard to the law. And that is a problem. But Andy, I don't see, what is the benefit of that? We're telling people in the market, look guys, we're just a terrible source of noise. When we take actions normally, we take actions that may not be intended to help the economy. If you want to know what we're going to do, decide what people like us do on the basis of our record and put your money where your mouth is. And I frequently think, and this is impolitic of me, to think that way. What is the job of people who make their living off the market, of the financial markets? It's to make a living off the financial markets and to thereby, if you believe in some invisible hand, and to thereby cause the markets to move in a direction that supports, or in cases where you're screwing up, makes more difficult the job of the central bank. So they got to do something. And I can't figure out, aside from making their lives easier, what we're doing. That's a question, Andy.
So I think that what the Fed has said many times is data dependent, not calendar dependent, and that's what a benchmark is. That's the whole point of the quantitative strategy, is to explain how and even contingency planning how things would change if something happens during the year.
So we have, let me just interrupt. One last question from Mike Borda.
Stan, my question is, why was Greenspan so successful in following what maybe, ex post at least rule-like policy? Was it good luck or was it good policy? This is an old question, and the reason that people often give for what happened since is, well, we had a big crisis. And so my question is this crisis a climacteric? Is it a real change in the world, or are we going to go back to something like a normality? And my reading of American history is we're going to go back. And if we're going to go back, then why can't we have a kind of rules-based system?
But what is the benefit of the rules-based system if you appoint decent people to the job and they say this is what we plan on doing, but they don't follow a rule that is publicly announced? What is the benefit of that? I'm going to stick to this. I know there'll be occasions when it's wrong. Why do I have to say that? Yeah, but the question is, am I committed to this thing or not? Are there occasions on which I will be doing things which I otherwise wouldn't do if I didn't have the rule?
You do it for 6 weeks at a time. You see, for the next 6 weeks, we have Fed funds rate.
That's true. I mean, the Bank of India has, I think, only 4 scheduled meetings a year. But they're allowed to change the rate in between meetings, and apparently they meet every week to change. So I'm not sure that's what we do, but I think
rules are contingent. You've said this before. It's the contingencies that matter.
I think we have to stop. I agree we shouldn't have meetings every week. But Stan, thank you so much. This is terrific.
Thank you, John.
Don't go anywhere. We're going to go straight to the next session here.
Hold my slides, are they up already?
I already have it here.
Oh,
Just
okay.
gonna open it from there. I'll put it up on the screen when we start.
Oh, I see.
Yeah.
Okay.
So let's get started. I know everyone wants to chat, but we got a conference to run here. Yep, that means you too, Marty.
Everybody, thank you very much for taking your seats. The break has been overruled because we went over. We got a chance to listen to Stan Fischer's thoughtful remarks, and he's going to stick around. The two people that are in this audience for whom I have learned so much, and who neither of which I was fortunate enough to work with or under in government, was George Shultz and Stan Fischer. So it's an honor that they're both here. So what we're going to try to do over the course of the next 45 minutes or so is try to broaden this discussion. Maybe some of the discussion has been preoccupied with rules or no rules, but I think Stan Fischer rightly said that in the back of his mind, and I'll paraphrase, he's always worried that some big shock is coming. So what Markus and I are going to try to do over this period is Markus is going to offer a presentation on some of the risks in and around Europe. The reason why I'm particularly honored to be sharing this panel with him is because, unlike some, he's given great thought to risks that cross borders. He's given great thought to the relationship between financial markets and the real economy. And he's also given great thought to unanticipated shocks. So I'm going to defer to Markus to begin with about a 20-minute presentation on that subject. I'll then offer a view about shocks that really build on a couple of the things that Stan mentioned. Then we'll open it up to questions. Markus needs no introduction, a prominent professor of economics at Princeton and a scholar of subjects that are of great interest to many of us here. Markus.
Thanks a lot, and thanks for giving me this opportunity to present my work here. I will talk about something which is based on the book I wrote with Harold James, a historian at Princeton, Job Orlando, as well. So let me start on rules and discretion. We'll come back into this talk as well. But what I wanted to say, I want to give you a flavor why it was so difficult in Europe to solve the euro crisis. And I think one reason is that the ideas matter a lot, and different people have different views how to manage the euro crisis, different economic philosophies, and I want to show you how these differences manifested it themselves. And you can see some in the US, but much more pronounced in Europe, different philosophies. And before I do this, let me just highlight the watershed moments in the euro crisis. So the euro crisis, essentially in the late 2009, we discovered that in Greece there were big problems with regard to the budget. But then it really started in 2010, and there was a huge power shift. So Europe was very much driven by Brussels, a supranational arrangement. And in the spring of 2000, there was a shift towards an intergovernmental arrangement. So there was essentially a totally different way of managing the things, which was essentially at the European Council, where the government meets and then the government make decisions rather than the Commission, the European Commission making the decisions. So there's this huge power shift. And then there was in 2010, in October, there was a famous walk of Angela Merkel and Nicolas Sarkozy on the beach of Deauville, deciding that there will be a restructuring of Greek debt. So there was this private sector involvement, PSI as it was called. Huge disagreement between France and Germany. And then in the summer of 2012, just prior to the Olympic Games, there was a famous whatever it takes speech by Mario Draghi, which really brought the spreads down dramatically. even though not a single euro was spent on this. Another watershed moment was then in spring of 2013, the Cyprus bail-in, a shift from bailout to a bail-in philosophy. And then there was the Brexit. And let me just walk you through the 4 dimensions which really matter a lot where there are differences. And I want to emphasize really the difference between France and Germany, because these are the 2 countries which are very influential within Europe. And these are the 2 countries, if they agree, then things can be moved forward. And many other countries fall in this so-called Rhine divide. So there's the River Rhine, and it divides essentially the views between France and Germany. And I want to do it a little bit in a black and white fashion, some ideal types a la Max Weber, in order to show and highlight, really make it more stark, these differences. And the first difference comes back to the theme of this conference, rules versus discretion. The Germans are very much rule-driven. They want to have ex-ante set up rules, and then they follow these rules, while the French are much more interventionistic, and there's discretion when you can intervene. But actually, it's not so simple. The French philosophy is much more subtle than just discretion. Because if you have discretion, you always have this time inconsistency problem. You're exposed, you would like to promise something or do something, but tomorrow comes around, you use your discretion and change your mind, and people anticipate this, so at the end of the day, you suffer from this huge time inconsistency problem. The French notice and more aware of this problem, so their philosophy is much more, in certain dimensions, we really commit very powerfully. We call this a straitjacket commitment, so you really commit, and I will come to examples. And then in other dimensions, you have to have very powerful discretion. So you have this multi-dimensional space, some dimension you lock in very forcefully, and the other ones you have to move very flexibly. While the Germans, they're like a system which has rules and has safety valves, escape valves, and all the other things. You don't have to intervene exposed at all, okay, or ideally. So that's a different philosophy. Let me give you some examples. One example is, it is actually the French who never want the credit restructuring, no default. It were the Germans who pushed through the PSI, the Greek restructuring of the debt. That's a famous walk I mentioned by Angela Merkel and Nicolas Sarkozy in October 2010. So how can you achieve that? And there's a huge debate going on. How can you commit never to default your sovereign bonds? You take your banks as hostage. So you stuff the bonds into your banks, and if you default, you ruin your banking system. This is a huge commitment device. The Germans, on the other hand, they would like to have risk weights on the sovereign bonds in order to have equity cushions. Then you could restructure. And that's a huge battle going on at the moment. How much risk weight should the sovereign bonds have on the balance sheet? Should we be able then to restructure? And the French said, no. This ruins our commitment device not to default at all. Okay? So you can see this, this diabolic loop or this doom loop between sovereign risk and banking risk, where this, when the sovereign risk goes up, the banks suffer because the bonds suffer in value, hence they give less loans, the economic growth will go down, and the bailout probability goes up. So these 2 things are linked. That's a good thing to have because it's a powerful commitment device. Okay? If you have a lot of risk weights on your sovereign bonds and the banks have to hold a lot of equity and have shock absorbers, then actually you don't have that. So that's one dimension. You see this playing out very prominently. I put Italy also here on the French side, of course, that's not only the Rhine divide. There's huge battles going on at the moment. The other thing is, when the Maastricht Treaty was set up, France was pushing not to have any exit rules from the monetary union. Okay? Again, you commit to be part of the currency union. There's no way to get out of it. Well, the Germans were much more in favor of flexible exchange rates. So if you think about pegs versus flexible exchange rates, the Germans are always in favor of flexible exchange rates, similar to the Canadians and so forth. And that's, if you put it in this Mundell-Fleming trilemma, so you can pick 2 out of the 3 desired features. France is on one side for a managed fixed exchange rate, give up your free capital flow, and both want autonomous monetary policy, while Germany is much more for free capital flow and your floating exchange rate. So again, you don't commit yourself. So in French philosophy, you commit yourself in certain dimensions, not to default for a currency union or a strict peg. And then you have to actively manage the other dimensions, while Germany has much more a system in mind. We don't have to actively manage, and you have a lot of flexibility built in the system. So that's the first dimension, discretion versus rules. I didn't say committees versus rules, but discretion versus rules. And the second dimension is solidarity versus liability, which played out big time as well. So one dimension is where you say, do you want to have a fiscal union? Essentially, everybody is liable for everybody else. Everybody can go into debt, and then the others are liable for that. That's solidarity, and that's also in the French Revolution already. The German ordoliberalism philosophy is much more that this liability principle. If you are in charge, you're liable. You never separate control from liability. This has to be united. So no bailout. You always have this bail-in philosophy. So you don't want a joint liability. There was this big debate where the French were always pushing for Eurobonds, joint liability, while the Germans refused to have any joint liability bond structure. And Merkel said, not in, as long as I'm in power, she said, not in my lifetime there will be a Eurobond. Okay, that's another dimension. Of course, if you have straitjacket commitment that you never default on your bonds anyway, then you can have joint liability because nobody will ever default, only in extreme circumstances. The third dimension where they differ a lot is on liquidity, on solvency. And if you think about it, whenever there are financial difficulties and you look back, it was always the French side saying, oh, there's a liquidity problem, we have to intervene, while the Germans said, no, whenever there's a financial difficulties, it's a solvency problem, you just throw good money after bad, okay? So you shouldn't do it at all. So liquidity problems you can characterize in two forms. So one is you can have this multiple equilibria liquidity problems, where you have a good equilibrium and a bad equilibrium, and all what it takes is a big bazooka. The term big bazooka came out of the UK, where the UK, Cameron was pushing, or Osborne was pushing for a big bazooka, saying, oh, just show the big bazooka, and then all the problems will be solved. And of course, others were pushing on this. And you might argue that Mario Draghi's London speech in the summer of 2012 was such a big bazooka. Essentially, the OMT, never a single euro was spent on the OMT. Mario Draghi gave the speech in the summer of 2012. The OMT was then finalized and announced only in the late summer, August, September, and it was never activated. Nevertheless, all the spreads came down dramatically. Of course, the Germans said, oh, that's just a guarantee extended by the ECB. That's why the spreads came down. But essentially, you can see these differences. Another form of liquidity problems is just if this, the strategic complementarities are less pronounced and the demand curve is not inverted S-shaped, but like an inverted integral or flipped over integral, then it's more an amplification. Then you say, oh, if I put a euro in or a dollar in, I get a huge kick out of it because of this amplification. So the expected net present value of a bailout is positive. I just put a euro in and I get 10 euros out of it, so that's a good deal. And what's the net present value of a bailout? It's the present value of bailing out versus the present value of not bailing out. And what's the present value of not bailing out depends very much what your idea is about, what are the contagion, a systemic risk, and all these things. And there's also huge disagreement. So from a French perspective, the bailout, the contagion effects, systemic risks are very, very powerful. And this played out very extremely in the Cyprus crisis in the spring 2013. Remember, Cyprus had this business model to attract black money from Russian oligarchs and others to become a bank center, a financial center and all that. And then the whole thing didn't work anymore. And the Germans, I still remember, said very prominently, if the European taxpayer has to bail out Russian oligarchs, and if this is systemic, then if Cyprus is systemic, then everything is systemic. Okay. So the no bailout rule, which is enshrined in the Maastricht Treaty, will be totally irrelevant anymore because there will be bailouts everywhere. And actually the Cyprus event, the Germans prevailed on this, led to a bail-in rule where then credit and bondholders and even deposit holders, large deposit holders were bailed in, led to a real shift in the thinking in Europe, and the bail-in rule was established, which later in Italy in 2015, the fall of 2015, and even today, makes it very, very difficult to fix the banking sector. So, but again, the solvency versus liquidity. Now, the fourth dimension everybody knows about between Keynesian stimulus and austerity and reforms. I should say that there's a huge difference what to emphasize. We all agree, Keynesian models, I think we all agree that in downturns when aggregate demand is depressed, you don't want to create additional uncertainty through reforms and depress demand even further. But I think what the Germans emphasize, at some point you have to do structural reforms, and when can you do them for political economy reasons? Okay? And typically you can only do these reforms when you're in a crisis, because that's when you can signal to the population, now, we have to do the structural reforms, otherwise, we will suffer in the long run. And that's essentially where there's a difference in emphasis. Do you emphasize the economic arguments, or do you emphasize more the political economy arguments? But in general, what I want to go back and say, is this hopeless in Europe? Because, these two countries, the two main countries which drive the whole economic and political integration across Europe, they have such difference in economic philosophies. How can there be any way common European Union in the long run? And I want to give you some argument that actually there is hope. And the hope is that if you go back in history, the two countries have changed sides several times in terms of what philosophy they follow. Okay? And these differences are not cast in stone. They're actually quite flexible. So you might say in the first side, France is this absolutism, centrally organized country. You can always intervene ex post, so discretion is very powerful. And in Germany, you can't do this. It's federal structure, thousands of little dukes will intervene, so you need ex ante rules to govern the system. But it was not this case. So it was very different before the Second World War. So if you go through history, I will skip the first one. The laissez-faire approach, not to intervene, that's a French thing. Laissez-faire is a French word. And it was in Germany in the 18th and 19th century where there was this cameralism of state tradition. Frederick the Great intervened a lot in Prussia, or even in the 19th century in imperialistic Germany. There was a lot of interventionistic. And it was only after the Second World War that these two things reversed. And I can go briefly into that. So in Germany, of course, it were the Nazis who were very centralized power, a lot of intervention. And there was this school, the Euroliberalists in Freiburg developed a school. There should be not so much arbitrariness in the government intervening all the time. So you want to restrain the government's power by ex ante rules. And this was with regard to any type of interventionistic approaches. And they promoted very much competition in order to avoid any concentration of power, be it political or be it economically. So you really push competition. That's essentially what they pushed. And then the Allies liked this approach because it took power away from Berlin and distributed it more evenly. And Germany had the Wirtschaftswunder and everything, the economic miracle, and everything went very well and fell in love with this new arrangement. In France, it was the opposite. Austerity was in the 1930s in France. They cut very much down the budget in the 1930s. And at that time, the biggest part of the budget was military spending. And then when in 1940 Germany attacked France and ran over them, it was argued that it was because of austerity which made France vulnerable against the German attack. And that's where the whole planning interventionistic approach became much more powerful. So they switched to the other side. So given that, I think you can see that this difference in the economic philosophies, they're not cast in stones, they can actually switch. Now let me end in my little time. So the Maastricht Treaty, which was signed in 92 and set up the European Union, focused a lot on these four dimensions I was talking about. It ignored very much the finance component. Why? Because in 1992, in the 80s when it was negotiated, late 80s when it was negotiated, we didn't live through the Southeast Asia crisis, which had this huge contagion waves. So we had to experience, the financial instability was not so at the forefront of their minds at that time. It was much more the fiscal aspects which played a big role. And I mentioned already that diabolic loop is doom loop, which one side sees as a commitment device and the other side sees as an amplification and destabilizer. And one reason why you have this doom loop or diabolic loop is because there's no safe asset which is a European-wide safe asset. Okay? And that's one proposal which is I want to mention briefly, is to make sure that you have some safe asset which is provided not by a subset of countries of the euro area, but is provided by all over in a symmetric way across Europe. So let me just illustrate what's going on at the moment. At the moment, if the crisis becomes more severe, you have flight to safety from the peripheral countries to the core countries. So there's flight to safety across borders. because the safe asset is just provided by a subset of Europe. So the idea is, I would like to put forward, is this European safe bond, or it's called now sovereign bond-backed securities in official lingo. The idea is essentially, it's just a tranching idea. So you just put 19 sovereign bonds together, up to 60% of GDP, let's say, and then you issue a senior bond and a junior bond. There's no joint liability, it's just simple pooling and tranching. And now if you have severe crisis, now what you want is that the banks, they're holding essentially the senior bond and not the junior bond. Of course, we're destroying this commitment device, but we stabilize the banks. And the second advantage is, now if there's flight to safety, it will not go from the peripheral countries to the core, it will go from the junior bond to the senior bond. And both bonds are European. Okay? So they're not national bonds, they're not bonds with a passport, they are bonds without a passport. They're both European, and you can stabilize the situation by doing so. Now let me conclude and just summarize what I just said. I think what mattered a lot and why the Euro crisis was so difficult to manage was that ideas matter. It's not only about interests. And you can see this in many examples where the interests are between Germany and France are very aligned, but the way they think, the lens through which they look through the lens of ideas, and they come to different conclusions and fight very hard for this. In 2010, there was a huge power shift away from Brussels towards the capitals first, with the involvement of the IMF. So the IMF was brought in. That moved power away from Brussels, shifted it very much to an intergovernmental arrangement. And then with Deauville, essentially it was between Paris and Berlin. I should just say, so after there was the private sector involvement, all the peripheral countries know if Germany were to whisper something to the media, there's something wrong, the yields would go up. And this gave a lot of extra leverage to Berlin and to some extent also Paris. There's the Rhine divide across the River Rhine, and different economic philosophies in many dimensions, but it can change, and it's not cast in stone. So there is a hope for convergence down the road. And then ultimately, I just mentioned some ideas, in particular on this SP's idea with the European safe bond. Instead of having national bonds, which leads to flight to safety across borders, you have essentially flight to safety from a junior bond to a senior bond, and that can be stabilizing, shifts you to a different equilibrium. And it takes the sovereign risk out of the bank's balance sheets. Thanks.
Thank you, Markus. Very helpful. So Markus, to my ear, told a story of reform. Stan Fischer earlier talked about the Bank of England and how they conduct business. They have been engaging in reforms about how they conduct business, make policy. What I'm going to do to try to build on those two discussions is tell a story of reform as well. Stan says that he likes it better to hear stories than data, so I'll try to put it simply. This is the story of a small central bank who, however imperfectly, engaged in a battle in the financial crisis in the US and may have secured a peace, but it's not a durable peace, a sustainable peace, unless the central bank undertakes real reforms. So as we gather here at Stanford, where I showed up 25 years ago knocking on George's door, as we gather here, look around Silicon Valley, everything's just perfect. It's another beautiful day. The long drought is over. The flowers are in full bloom. Buildings are being erected. Even we at Hoover cannot resist the temptation to put up a building of our own. Students are gravitating new fields of study. They go to the edge of campus. Their ideas are being funded. Low-cost computing power, new analytic tools. Everything's working out perfectly. According to popular lore here in the Valley, we're in a long epic of prosperity. We're in a sustainable and durable equilibrium to which we should all say, what could possibly go wrong? That's the central question that central banks should be asking as well. And this isn't antithetical to the remit that we all know. The Fed was founded in response to a crisis. Financial and economic shocks have marked the last century. They've tested the economy. And these economic and financial shocks, those things that Stan Fischer said in the back of his mind as a central banker he always worries about, nothing could put the Fed farther away from its statutory objectives of price stability and stable employment maximum employment, then another shock. But leading Fed officials at press conferences and speeches are confidently predicting a benign external environment as far as the eye can see. Steady growth, stable inflation, and financial assets which, according to their models, are at perfectly fair values. They've all but proclaimed their mission accomplished, their targets achieved. From the latest view of their dots, they're virtually on top of each other. The last time I can recall such uniformity of opinion among central bankers, among many, if not most, in the academy, and among market participants was about 10 years ago. We gather here today at another important time, where the broad conduct of U.S. economic policies that George referenced are now being debated in Washington. So many of the issues that were discussed before this panel, discussed yesterday, they sure matter, but they matter in the context of something broader. I can't help but opine just with a few thoughts on them. First, we shouldn't sit here and encourage policymakers to fiddle with the natural rate of employment to rationalize the near-term conduct of policy. We shouldn't accept their newfound conviction that some low R star is a fixed feature of future monetary policy. And we should resist the pseudo-scientific precision being assigned to the Fed's preferred measure of inflation. This measure of inflation is not reliable to the 10th or 100th of a percent. It is not a good arbiter of the output gap, and it is especially poor proxy for financial stability. So judgments on these issues about the balance sheet and R star, these matter. I'm not trying to dismiss them, but I want to put them in the context of the Fed's more difficult and consequential mission to mitigate the probabilities of and damage to the economy that may arise from the next shock. Our mandate about inflation and employment demand nothing less. So, to Markus's point, we should stand here and engage in a fundamental rethinking of the Fed's strategy, its tools, its governance, and its communications. We should not take the cacophony as is and say we can't do better. We shouldn't take the deliberation process of the Fed and say, well, we're stuck with it. What we should do is ask ourselves, what can we do to improve it? That would clarify the Fed's responsibilities. It would improve the Fed's decision-making, and it would bolster its credibility. A reformed central bank could prove useful to mitigate the risks of this next crisis and prove essential to a forceful and efficacious response to these inevitable challenges. There's no holiday from history, there's no holiday from shocks, and we policymakers, past and present, should not squander this grace period where all seems to be going perfectly well on a victory lap. So I don't want to leave you with the impression that somehow I have a perfect crystal ball. I don't, but neither do they. The most important forecaster trait is humility. The most important forecasting measure is the confidence interval. The most common forecasting error is groupthink. And the best forecasting fix is among us, a humble, independent, diverse, intellectually rigorous, and cohesive group who are not satisfied with the status quo. The Fed has a lot riding on its outlook, too much in my view, and its institutional inclinations give me pause. Policymakers should evaluate the tail risks of their forecasts, frankly, with more care than the central tendency. And they must judge their ability to respond in less likely, but frankly more disruptive scenarios. Now maybe as I was putting pen to paper on my trip out here, I thought the scars of the last crisis might be burdening me with unnecessary worry. Maybe the levers of macroeconomic policy have made economic, credit, financial cycles an artifact of history. Maybe we're going to get another perfectly satisfactory period in front of us of moderate growth and inflation. I wouldn't bet on it. We should not mistake the present situation for permanence. We should not confuse the post-crisis period of benign aggregate conditions with a sustainable, durable equilibrium. We should particularly not be comforted by the low implied measures of volatility across financial markets. We should query whether a sudden shift in expectations would make these asset prices an amplifier of distress rather than the shock absorber they ought to be. We should not encourage the financial markets to be the handmaiden of the central bank. We should allow asset prices to be an independent source of information because we need that. to conduct policy. And we should not allow a failure of imagination, a failure of preparation, or a lack of courage to keep any of us from pursuing a robust reform agenda equal to these risks. And we should not conflate a forward-looking policy of reform with a policy of looking back, pining for the good old days when monetary policy was ostensibly perfected. The conduct of monetary policy has never been easy. It has never been simple. And the lessons learned in the last decade alone about money, credit, finance, global interconnectedness should be incorporated into a 21st century monetary framework. The challenges of the next several years are different from those that confronted the Fed in the 1970s when Paul Volcker stood tall. They're different than the challenges that confronted Ben Bernanke in the darkest days of the financial crisis. But the challenges are no less consequential. Let me say just a word, if I could, about these 4 areas of reform. And then obviously Markus and I will open it up to questions about reforms both in Europe and the US. First is a reform of strategy. It is a false choice, I hope not a false choice laid down to this point, between unfettered discretion on the one hand and a mechanical rule on the other. But the familiar refrain from the last crisis that a plan beats no plan might be true, but a strategy beats a plan every time. And as far as I can tell, I haven't seen one. A durable strategy can be understood and relied upon. It should be operative through the business and financial cycle. And it would scarcely require Fed speakers to rush to update their guidance to market participants between blackout periods. A reform strategy would make the medium-term time horizon its North Star. The Fed wouldn't be beguiled by the whimsy of day traders and the variance of lagging data. The Fed's reaction function would be less sensitive to normal financial market ups and downs. They happen and they should. A reform strategy would account for the possibility of demand and supply side changes to the economy, some of which George was referencing in his question to Stan. And it should show greater respect for the micro foundations of macroeconomics. To inform future inflation and output, it should take special note of contemporaneous real-time data and pay careful attention to forward-looking trends. Silicon Valley is awash with new analytic tools to figure out not what happened a month ago or 3 months ago, but what's happening in real time. Those should be front and center in policymakers' playbooks. And to Markus's point about the experience in Europe, I'll only add this. This is a parochial American view I'm sharing. But if we don't have a strategy, I don't know how the rest of the world's central banks are exactly supposed to conduct their business. International spillovers in monetary policy include intellectual spillovers. The G20 relies on the US to deliver strong growth for sure, but foreign central banks and foreign ministers rely upon a steady and well-understood Fed strategy. Absent reform of the Fed's framework, foreign central bank choices risk being in limbo, and the lack of the reform at the Fed makes it more likely the next foreign financial shock, of which Markus made some reference, could find its way to our shores. Second, reform tools. I heard a question earlier about tools. The Fed's comfort with its conduct of monetary policy seems to me based in part on these Dodd-Frank inspired reforms in the regulatory area. The argument goes something like this. Monetary policy's mission can be focused on the modal outlook because these other prudential policies will manage tail risks. I don't believe it. Microprudential regulatory changes in the post-crisis era, most of which were taken up by Dodd-Frank, but the Fed had authority to do itself, are inadequate to deal with the next financial shock. And the macroprudential policy toolkit, which the Bank of England is testing, the Fed is talking about, is underdeveloped to deal with these tail risks. Until these areas of regulation and supervision are made more robust, monetary bears the substantial burden, and we ought not fool or think otherwise. As to the tools being undertaken by the Fed, I must say I'm confused by the normalization strategy. Its preferred sequencing of rate increases and balance sheet reductions differ markedly from what was agreed back in the war room when we conceived of QE to start with. There might be good reason for that. But the transmission mechanism of rate changes and the transmission mechanism of balance sheet adjustments are markedly different than projected, and we must admit so too are the distributional effects. This merits a more robust public explanation, and it shouldn't just be passed over. According to the Fed's recent commentary, the balance sheet taper could well come by the end of this year. In my view, the Fed would be prudent to engage in substantive discussions with the Treasury Department so that the flow of issuance is well coordinated and the duration of outstanding securities understood. The absence of clarity around important questions at this late date does no favors to the Fed, does no favors to the rest of government or to the broader economy. 2 more points. The next is on governance. The Fed's existing model of governance is ripe for reform. The Fed looks to me to be too far in a defensive crouch, and it should resist the reflexive response that any proposed changes in its governance are somehow a threat to the institution's independence. My time at the Fed and subsequent experience at the Bank of England confirm the wisdom of what former colleague and Professor Peter Conti Brown wrote recently when he said the following: having the right institutional design isn't a sideshow to the real questions of monetary policy and financial regulation. Governance may in fact be the whole show. Changes are in order in how the Fed organizes itself, conducts its business, deliberates policy choices, and makes its decisions. In short, deliberation should be more robust, decisions less constrained. Stan referenced the comparison that I did between the Bank of England and how they conduct policy and the Fed, and he said, I think, with plenty of nuance, the comparison doesn't stack up very favorably for the US, and we shouldn't let that stand. The existing governance structure reinforces a groupthink. It places the Fed at considerable institutional risk when the next crisis strikes, and it makes the next crisis more likely to be harmful. As those of us in this room know, this is our 3rd experiment at a central bank. And it's our 3rd because the first 2 didn't end up as we would have liked. The Fed is on, I think, more dangerous ground in thinking about how it should run itself and how it can survive and thrive in the next crisis than many would have us believe. 4th, communications. The Fed's come a long way from former Bank of England Governor Montague Norman's rather famed aphorism, where he counseled central banks to never explain and never excuse. Well, I suppose nothing compares with the zeal of the converted. The Fed of modern times is always communicating. Communications has become so important to Fed policymakers, they now find themselves doing something new, communicating about communicating, lest they be misunderstood. Leading policymakers believe the so-called taper tantrum in 2013 was a communications failure that caused deep financial instability. So they must somehow toil to ensure that that error is not repeated. The spike in volatility of the long bond, however unanticipated, however clumsy, served as a useful reminder to investors that complacency is a killer. If that's the magnitude of the tail risk that consumes the central bank, we indeed have a lot to be worried about. Some emerging market economies coming out of the taper tantrum were pushed to put their houses in order, and bond investors were made a bit less complacent. In the monthly window between FOMC meetings, there are dozens of statements, minutes, speeches, forecasts, predictions, and reporting informed by policymakers. Great attention is paid by policymakers to the latest data and inflation prints. That's no doubt the case this morning. And the immediate effect that has on the next decision. What does this morning's announcement about monthly payrolls say about June? I probably speak in the minority here. There is little knowledge to be learned from the latest Fed forecast, little insight to be gleaned from the last piece of government data. I worry that Fed policymakers find themselves score settling with one another, while Fed watchers find themselves score counting hawks and doves. All the while, the big questions for the economy go unanswered, and the big risks unaddressed. Bagehot, I think, captured the essence of this dynamic when he said, quote, "Two hosts of eager disputants on this subject ask of every discussant the same question, are you with us or against us? And they care for little else." Well, as I've tried to say over the last 15 minutes or so, there's much about else we should care. So I'll end where I began here at Stanford. Those in the bright white lab coats on the other side of campus in the life sciences lab, they should be the starry-eyed true believers. Those wearing the T-shirts, the coders in the Palo Alto garages, they can be the eternal optimists. And those in the venture community, they can be the evangelists. And I wish them nothing but fame and fortune. But central bankers should be different. Their 15 minutes of fame should end when the crisis ends. And they should use the interregnum to take stock, deepen their knowledge base, bolster their capabilities, and fundamentally reform the institution before the next siren sounds. Because when it does, the Fed is unlikely to have conventional or unconventional armaments in sufficient supply. So the Fed's credibility will be at a premium. And this credibility will be significantly enhanced by first reforming its own policies and practices. So with that, I'd say, Markus, I'd be happy to take your questions. I know we're running a bit over, but we've been given a bit of a leave. So why don't we pause there and see what's on anyone's minds. See a question here on the aisle. Microphone's coming right here.
Thank you, Volker Wieland from Frankfurt University. I want to direct a comment at Markus, but it's not unrelated to the thoughts of Kevin Warsh in the US. If you think of the change, you mentioned the change in Germany, right, with World War II, and an important element was actually outside intervention and terrible experience. So I'm a professor in Frankfurt. We're actually located nowadays in what used to be the headquarters of IG Farben, a big chemical conglomerate, and what used to be the US Army headquarters of Europe, and was the seat of the military government, after World War II. And for example, there were many of the things setting up the rules and institutions of the state were basically handed as proposals from the military governors to the Germans, to the heads of the German states. For example, Frankfurt documents, which then were an important influence. So that's a name which became famous, the Frankfurt documents, handed by the military government over, which became a big influence on the later what was the basic law, or our version of a constitution. Same with the currency. So it's this combination which made the change, the horrible experience of disaster and this intervention. And if you move to today, the position you described also has a lot to do with experience. Contrary to France, we actually have a federalist structure. So there is in the population a big view on, yes, we could have a union of states, but the experience has not been all that good, because contrary to the US, we haven't had this working. The focus on no bailout is really because we have constantly bail-in Germany. So within Germany, we have the German states, the German Länder, and we have permanent recipients of transfers, Bremen, Berlin, Saarland. So that's where the proposals are coming from. And without going further, I think it's not going to be sufficient to just invent another financial instrument where you have to ask yourself, why isn't the market already offering that? But I think what you need is really this, to make this work, and not having Marine Le Pen win in France, you need a focus on making control, when you're in control of your budget, of your policies, that you also have to be responsible, liable for the consequences. And, without going to a central government, which the French want the least, as you can see from the number of votes Marine Le Pen gets,
Markus,
you really have to move to that system.
Thank you.
Okay, so I agree with many things. So the US was instrumental, essentially, after the year to make this shift in Germany. It was also the first economic minister who essentially ruled against the US and removed the price controls, which led to this economic miracle. So there was some back and forth, and there was essentially the Order Liberalists, they had a big influence in Frankfurt as well. But the argument might be made, well, does it take a war to really change the attitudes towards an economic philosophy? And I don't think it really takes a war. I mean, I think the Euro crisis was a severe event for many of the citizens in Europe, and it might lead to a shift, and it led already to a shift. So there was a big shift towards a more bail-in philosophy. It might not have trickled down to the average citizen, but there is already a big rethink going on. You can see that there's some disagreement about this liability principle. I mean, the closest which comes to my mind is our principal agent type of modeling. So you have some risk sharing for some extreme tail risks. And when you're not in the tail risk region, when you're not in the tail risk, then you have this liability principle biting much more powerfully than because you're in charge of it. But if something extraordinary happens, then there might be, for some severe aspects, there might be, a way to share risks across nations. And over time, it might grow that you share more risks. So that was the same thing when Germany was united in the 19th century. There were also even different armies from Bavaria and Prussia and so forth, and it took, a long time to come closer together. Are the SPs, will they solve all the problems? I don't think so. I mean, they're just solving very particular problems. It's just a clever way to avoid joint liability, which is, I think, the political landscape is not there, and it's also not wise at the moment to have some joint liability. So it's a way to solve two problems. One is this diabolic loop or doom loop between banking risk and sovereign risk, which would make some restructuring more possible down the road because you lift this commitment device, and it would redirect flight to safety away from cross-border flows from a junior bond to a senior bond. So that's essentially just rechanneling things, destabilizing fundamental flows.
Right. Other questions?
David Mulford, Hoover. In your presentation, the word Brexit appeared. You made the comment that it doesn't necessarily take a war to make change. So I wonder whether you could look forward over the next couple of years of the Brexit negotiation and speculate or explain how you think this might affect the euro development, core ideas, and the ideas that you made in your presentation, because I think we're entering a very significant and uncertain period here.
Yeah, I agree with you that the Brexit will be a difficult period, in particular because the expectations and also the expectations which are projected to populations are not consistent with each other. So in the UK, there's some expectation everything will be fine and there will be no problems, and they can still be part of the common market and so forth. And there will be some huge disappointments, and the dangers are big that you play the national card later on. What we have seen so far, and this comes also from Trump's initial close cooperation with Russia, that the Europeans outside of the UK, they were actually moving closer together. So there was there's still a threat in Eastern Europe from the Russian side, and this led actually to a closer movement together, or continental Europe, and that also united Europe more with regard to the United Kingdom. And whether that's healthy or not, it would be nice if you can keep the United Kingdom as close as possible with the continental Europe, in particular for trade reasons, but also for security reasons, because the United Kingdom is still one of the major military players in Europe.
Here.
Thanks. Anne Saphir, Reuters. I just wanted to ask a quick political economy question to you, Kevin. What kind of indications are you seeing that the administration wants the kind of approach to the Fed and the kind of changes that you've been advocating?
So the good news about being back at Stanford is we get to explain what we think is the right outcome. We don't need to necessarily be burdened by the opinion polls or latest comings and goings in Washington. Now, I would say this, both in the context of Dodd-Frank on the regulatory side and in the conduct of monetary policy, there's much Congress might choose to do to change the rules. There's a lot of self-help that can be applied too. Almost all the authority granted to the Federal Reserve and other agencies under Dodd-Frank was authority that broadly the Federal Reserve already had. There's some exceptions to that. Almost all the changes that I'm discussing broadly about having a strategy, clearing up and fixing governance, being clear about the distributional consequences of tools, being clear to the world about how they'd work and why, and communications, these are reforms that can be taken up by the institution. In some sense, my real view is if the institution doesn't look first to itself for reform, then they might not like what happens at the other end of the political lens, particularly after the next slowdown, after the next recession, after the next shock. So that's really a call for self-help. You and others can judge whether it's feasible in the broader Washington consensus. But part of the benefit of being 3,000 miles away from Washington is we can sort of try to focus on what do we think is the right answer and leave it to others who are actually now burdened with these responsibilities to decide whether they wish to take it up. Other questions? Jim.
Jim Bullard, St. Louis Fed. So I have a question for Kevin. You seem to characterize one of the major problems of the Fed as groupthink. How would you, first of all, I'm not sure that that is the core problem, but maybe you can defend that a little bit. And what would you do to break down groupthink? What kinds of things do you think the Fed should be doing in that dimension?
Yeah. So it's a great question. I've written a paper on it, but I'll try to summarize a couple of the ideas here, Jim. I think there is a tendency, particularly as Stan suggests, when you have a committee as large as the committee is that was established by Congress, amid uncertainties, to try to find an anchor, try to find some commonality, and that's a natural phenomenon of human behavior. And FERBIS, the dynamic stochastic general equilibrium model that is at the core of the Fed's thinking and has been at the core of its thinking for 40 years, though revisions are made all the time, I think ends up being the device through which a lot of discussions are had in the conduct of policy, at least back in my day. I've been gone for 6 years. The flaws in the model, though, should be not hidden but exposed. So a couple of things, as you know better than I, that are missing from the model. For example, financial markets. There are no asset prices in the model. Well, why would that be? Well, in 1978, we might have well believed that assets are always perfectly efficient, so we needn't clutter up this elegant model with such a thing. But if we think broadly about what we learned about the crisis, what we learned broadly from Markus's work about booms and busts and shocks along the last 100 years, you would say, well, market prices can be very useful and efficient, but not always so. And you'd also recognize that when the Fed's objective function in the crisis and thereafter was actually to move asset prices around, that asset prices might be fair and efficient with the thumb of the Fed on it. So that model doesn't include asset prices, and yet almost all, or I should be a little bit more fair, much of the benefit of monetary policy through quantitative easing happens through asset prices, is quite something to be missing from the core. Second, from the model, as you know, the model does not include the rest of the world. So we add a couple of lines and call them net exports, and we call it our global economic model. Well, again, in 1978, that model might have been a fair approximation of the United States, largely domestic economy, shocks, inflation, prices, capital flows overseas don't necessarily interfere with the output gap at the core of the model. That's not the world we're in today. Everything that's happening in Europe, everything that's happening in Britain is of second-order consequence, if not first-order consequence. You know, I think the right reply is Ben Bernanke's, for whom you know I've got great affection, and he would say, well, it takes a model to beat a model. Well, if we had that other model, I would be serving it up here. We don't. But we shouldn't hide from the frailties of the model. We shouldn't all hew to a model that we know is fundamentally broken and misses key elements. So a broader discussion about what ails us would be one part of it, and I'll only answer with a second. I think the groupthink comes not from bad intentions, it comes from the best of intentions, and it comes from a willingness and a desire for there to be comity in the committee, a willingness to get along. This is about good intentions of patriots that are trying to do the right thing for the economy. But if the backgrounds of the patriots are so similar, if the long tenured history in the system is so deep, some fresh air could be useful. Fresh air from the real side of the economy, fresh air from financial markets, fresh air from what's happening overseas. And so I think in the attempt actually at civility, we end up at press conferences where the chair has a very difficult task to speak for the committee. And the chair, as a result, uses other devices to show the commonality, like these dot plots. The only problem with these dot plots is they've been wrong for 9 years. Wouldn't say mine would be right. But imagine if at the next FOMC meeting, at the next Fed press conference, We didn't dwell on the change of a tenth to inflation, a tenth of change to GDP. We just sort of put that aside. And we said, well, you know what the committee's really been struggling at, and what I'm going to make the focus of the summer of 2017 is the productivity puzzle. So we don't have that right. We don't have our star right. We don't have our star right. We don't have monetary policy right. It is not a sign of weakness to say what we don't know. It's a sign of strength. So those are the sorts of things, and I think the governance, which we've looked at across countries, including the ECB and the Bank of England, have a lot of ways in which this same group of people could end up with more robust deliberations, feel more comfortable dissenting or agreeing, and have a discussion where in 2017 we don't give 112 more speeches on the economic outlook about dots. And we devoted $2.5 billion of taxpayer money to the fundamental questions which are more consequential. And that $2.5 billion, I would argue, the incredible brain power of 650 PhD economists could be focused on these big and harder questions about productivity, about shocks, about the role of markets, about the bleeding of asset prices and international flows. We have the capability, you have the capability to do it, but I think it needs to be brought to the fore. I think we've got time for another question or nope, that's it. John cut you off, Michael, not me. I apologize. Excellent, thank you. I'll go back and forth. I'll talk to you in just a second.
to make some remarks and then vacate the stage and let some other people come up and argue about what I said or whatever they want to argue about. My basic theme is that the Fed has immense responsibilities and limited tools. So how do they maneuver in that setting? And I want to say a few words to underline how much change is coming at us fairly rapidly. First of all, there's the information and communication age. In the past, there's diversity everywhere. In the past, it's been possible to ignore it or suppress it. That day is ending. What that means is that the diverse populations express themselves, and they want to be paid attention to. And in the end, you don't have an alternative, because they can protest, and sometimes the protest can be violent. So somehow government policy, writ large, has to be able to cope and learn how to govern over diversity. So that's number one. Number two, we have this awesome combination coming at us fast of a combination of artificial intelligence and what's called 3D printing. I don't know why it's called printing. It should be called 3D manufacturing. What this means is that, on the one hand, very powerful weaponry can be made in large quantities inexpensively. So you don't have to be a government to get a hold of something that could create chaos, even an individual. This underlines the problem of managing differences and diversity, because people can get a hold of this weaponry. I can imagine large-scale drones, not just a drone, a scale of drones coming with weaponry on it. Think of the chaos that that can produce. At the same time, these same forces can produce a large volume of what you need where you are. For example, right now in Tokyo, there's a factory producing lettuce. How can a factory produce lettuce? Come on. There is. It's happening. There's also one in New York City. So the implications of this for trade are pretty big. So my basic message is that there are huge problems out there that governance is going to have to cope with. And how well it does the job is going to have a big impact on what our quality of life is going to be. And the Fed is there as one of the most powerful agencies of the government. And it seems to me it needs to think about its role, because it's powerful, it has big tools, but it doesn't have all the tools. So it has to figure out how you interact or think a little more elegantly than is now the case with people who have other tools. That's my message.
Okay. Thank you, George. I'm supposed to moderate this panel, but it's obviously not necessary. But I do want to thank you for participating.
Yeah, and you told me to get out of the way. Okay. The Taylor rule.
Okay, I'd like to welcome everyone to the policy panel. This is the emerging tradition of this seminar, where we kind of sum up and think about how does this affect policy. I'd like to welcome our guest, Jim Bullard from St. Louis, Charlie Evans from Chicago, and Eric Rosengren from Boston. What we're going to do is I'm going to tee up some questions. No surprise, I'm going to ask them basically their views on the themes of this conference, and not just their views, but how you see the discussion going in the policy community as well as the committee. I'll then ask you if there's an important question I've left out and give you a chance to say whatever really important thing I forgot to ask you. And then we'll move on to questions from the floor. We not only have current bank presidents and FOMC members here, we have some former, can I have hands? Who has been on the FOMC or run a bank previously? Charlie, where are you? Yeah, okay. So you guys, I'll give you guys first shot at comments and or questions, and then we'll move to, I'm just warning you, it's coming. And then we'll go to Q&A from the floor. Okay, so, to be fair, I guess what I'll do is I'll ask a question, and then we'll go this way, and then I'll ask another question, and then we'll go this way. But feel free also to respond to each other, and then when the discussion is petering off, I'll ask the next question. So let's start with where we started the conference, the balance sheet question. What's the new normal of reserves? Should the Fed keep a big supply of interest-paying excess reserves? Should it open access to reserves to non-banks even more? Or should the Fed run monetary policy as it used to do with a very small amount of non-interest-bearing reserves? Or should we continue now with a trillion of reserves at least and interest on excess reserves? Or how about my wide open balance sheet, 3%, come and get it? Should the balance sheet be a separate tool? Should we do more QE in the next recession? And that's the liability side. The asset side, does QE work, if you think it does, on the asset side or on the liability side? What kind of assets should the Fed buy? Do you welcome restrictions or pre-commitments, two words for the same thing? Or should the Fed buy widely, MBS, corporate bonds, stocks, whatever it seems it needs? Well, I got plenty of questions for you. So Charlie, why don't you start in and
Gee, John, there's so much there. I'll just take the one that I have an opinion on. Well, I mean, obviously our balance sheet is very large. Everybody recognizes that, and nobody has the expectation that we're going to keep the balance sheet at $4.5 trillion, like where we are. The committee has indicated at a variety of moments that we anticipate a smaller balance sheet, but of course it's not going to be as low as back in 2007 because the economy has grown and there's more currency out there. The minutes have been pretty clear about describing how the committee's had these discussions, and we're actively wondering about the benefits of a larger balance sheet that could be consistent with a floor system for some financial stability reasons, or perhaps going back to previous model where reserves are scarce and we had an active interbank market. There are times where, given my 25 years in the Fed, I have some sympathy for the old model of scarce reserves, and certainly a large balance sheet does open yourself up to political interest weighing in perhaps. But a lot of times Congress would be passing a law anyway to direct you to do these things, and the democracy is Congress can pass laws. So I just don't know where we'll be. But the committee's thinking about that. Everybody else is going to weigh in on this?
Sure,
Yeah, okay.
until you get tired of it.
So that's the easy part. Jim, why don't you take the harder part?
I agree with Charlie that the $4.5 trillion level that we're at now for the size of the balance sheet is larger than we would like. So that's why I've been an advocate of beginning to shrink the balance sheet by ending the reinvestment policy. I think we could go down to as low as $2 trillion because the currency is about 1.5 and a couple of $100 billion for reserves would probably get you down to a floor system, although I wouldn't be firm on that, but that gives you an order of magnitude about how far we are away from where we need to be, even if you wanted to run a floor system. So I think we got a long ways to go, and we might as well get started on that. I do think it's one of the questions is, would there be QE in the next recession? I think that's a distinct possibility. And therefore, the prudent thing to do would be to create policy space on the balance sheet side as we are on the policy rate side, so that if a future committee wanted to contemplate that kind of policy, if we hit the zero bound in the future, that we'd be able to do so. I also think that we have a rather odd twist operation going on, at least rhetorically right now, where we're raising the policy rate and therefore trying to normalize conditions, but we haven't changed the balance sheet. And according to our rhetoric and our statement, that balance sheet is putting downward pressure on longer term and medium term yields. And so it's a little bit odd to be saying we're going to raise the short term rate, which would normally be thought to be, all else equal, raising everything along the yield curve. But nevertheless, we're putting downward pressure on the other parts of the yield curve. So I think that that's an inconsistency that needs to be ironed out, and that's another reason why I've advocated getting going on balance sheet normalization. On the QE, on the whether QE works or not, I would challenge people here, because a lot of times you get people saying, "Oh, QE didn't have any effect." Maybe I heard John Cochrane sort of say that yesterday. So let me push back against that a little bit. I think you have a distinct set of empirical facts associated with QE, and any theory that you have has to explain these facts. Because we have experiments in Europe, in the US, and in Japan, and it seems pretty clear what happened. Equity prices seem to react a lot. So you really had big movements in equity prices. That's one thing that happened. You seem to have big movements in exchange rates. We saw that in 2014 with the euro. We also saw that in Japan. You also saw important effects on term premiums, longer term interest rates. Those seem to be significant. And then, puzzlingly, for me anyway, not much effect on inflation or inflation expectations. So whatever theory you want to write down, I think has to confront those facts. They aren't easy to confront in a model. And, so don't come to me and say this didn't do anything. It did something, but it's maybe not something that is as conventional as we thought it was. So those are my comments. So thank you.
So I'll just pick on a couple of comments that Jim talked about, and one was, what is the likelihood that we see a balance sheet that's swollen again? And so part of the system design has to be whether you think what's occurring right now is a one-time event or whether it's likely to occur more frequently. And when I think about the summary of economic projections, where we have a long-term federal funds rate that the committee thinks will be around 3%, and you think about how does the Federal Reserve normally respond when we have a recession, it's not at all uncommon to lower the federal funds rate by 500 basis points. So if you have 300 basis points in the longer run for the federal funds rate, but you need to go down by 500 basis points, it means we're going to hit the zero lower bound pretty frequently. So why is it that we're at the likely to be at the zero lower bound more frequently? I think there are several reasons. One is one of the benefits that we have right now is that we do have a 2% inflation rate, and I think that inflation expectations are getting well anchored. During previous periods, we had much higher inflation rate. I don't think that's a desirable thing, but the result is there's less of a buffer between where the nominal interest rate is and zero. I think there are two other trends, because it's not just the United States that's encountering this. Japan's experiencing it, and so is Europe. Population growth is much slower than it was a few decades back. That's true in the United States, it's true in Europe, it's true in Japan. It's not only slower births, but it's less immigration, and that's likely to be continuing. And productivity, I agree with Kevin, we don't completely understand why productivity seems as slow as it is, but productivity definitely seems to be relatively slow. So you combine a low population growth, low productivity, and a 2% inflation rate, and it's not all that surprising that much of the committee comes up with a number around 3%. So that means we're going to be here pretty frequently, and if we're going to be here pretty frequently, we need to come up with a system design that is equipped. What are we going to do when we hit the zero lower bound? And so I think it is inevitable that we're going to be talking about balance sheet expanding in future recessions, and I think actually in most recessions, unless they're very, very mild.
Let me push you guys a little bit. I presume you view the QE as working not by so much the issuance of reserves, but by the purchases of assets. You heard Charlie Plosser in our first panel warning about the political pressures to buy certain assets other than other assets, other political pressures to prop up certain prices than other prices. You're taking credit risk, you're taking term risk onto the Fed balance sheet. Does that worry you at all, or do you favor just a pure treasury strategy, or do you think that it's actually the reserves that matter, not the purchases anyway?
So the political economy question certainly worries me. I think it is a significant issue. But we have to deal with the reality that if you're going to have a Fed funds rate that's around 3% and recessions occur, what are you going to do when you hit the zero lower bound? So you need an alternative. In Europe, they've tried negative interest rates. There's probably a limit to how negative that can be until we get some of the new currencies that were talked about in the previous session, but I don't think that's likely to happen in the near term. And so we need an alternative of what we're going to do when we do hit the zero lower bound. So in discussing what the Federal Reserve should do, we're going to probably be confronted with a situation that, once again, inflation's below 2%, the unemployment rate's very high, and the short-term interest rate is at zero. Right now, I do think that there is a fair amount of empirical evidence that the large-scale asset purchases did make a difference. Let me just finish.
Oh, yeah, please.
The long-term treasuries did move down, and I think actually you can even look more recently as we've gotten closer to normalization and when we've stopped the purchase program, but the Europeans and the Japanese have not. Their 10-year treasuries are much lower than our 10-year treasury, and I don't think it's necessarily because they're viewed as much better credit risks than the United States. I think part of it is that they have a very different monetary policy than we have right now. And I would say when I give talks, particularly to financial audiences, they spend much more time asking me about the balance sheet than they do about the federal funds path, which tells me at least financial market participants think that it matters. So I think there is a fair amount of empirical evidence that it's had an effect. I do think it lowers long-term interest rates, and I do think it had an impact on the economy, and I think it's one reason why the U.S. is at full employment or possibly a little bit below, and why inflation is pretty close to 2%, and those countries that waited much longer before they engaged in quantitative easing are not nearly as far along as we are.
But I guess let me put the question and invite the other, I don't want to turn this into the end of the table discussion. Is this something that needs a strategy, a plan, a rule, what assets you buy, when you buy the assets? Or is it a, well, you know, we'll go into the firehouse and pull out whatever we think when the time comes?
I think the near term, I think this conference is very good on this. I think the near term challenge for the Fed is to realize that we're probably going to have to at least have QE available in the future. So that's I think we should be creating policy space for that. And then how to incorporate QE into the Fed's arsenal without bringing up the kinds of political economy problems that people have outlined here, which are very serious. So, you know, be able to pursue a policy like this up and down and not get the institution off track. That would be, you know, my near-term goal for Fed strategy.
You know, we are constrained in the assets that we can purchase. We cannot buy equities. We can't take risk like that. The Federal Reserve Act doesn't allow us to do that. So we buy treasuries, and we bought MBS. And, you know, now this is not a great thing in the sense, what I'm about to say is, if our MBS defaulted, we would get paid back. That's going to be coming out of, you know, the guarantees there. But, you know, from the Federal Reserve and safe assets, they have to be safe. Now, I'm not looking forward to future episodes at the zero lower bound, so I think it's extremely important that we
make sure that we hit our inflation objectives so that we've got at least as much cushion as we're supposed to have when we find ourselves in this situation. But, I'm with Ben Bernanke on this. He has said, and he's a scholar of the 1930s, Great Depression, and he said if you look at the Great Depression and the shocks that hit the system then, and you look at the shocks that hit the U.S. economy after Lehman, they were bigger. They were bigger more recently, and the unemployment rate was horrible at 10%, but wasn't 25%. And I think it's all of the efforts that, the Fed undertook in conjunction with other people in the administration, the liquidity programs, the stress test, and making sure that the banks had capital. So, we need to make sure we have that capability, but it'd be good to sort of also make sure we have the most vibrant economy so that we've got inflation and we're at full employment, so it's less likely that we have to face this soon.
Well, I think that brings us to the next question, really, because you mentioned inflation. R-star, if indeed the long-run real rate is falling, how should the Fed adapt? I think Eric sort of announced what I think is the standard view. We keep a 2% inflation target, and that means we're going to end up at 3% and probably run into the zero bound every recession. But maybe I might channel Charlie saying, well, maybe what we need is more headroom, and we need to get the nominal rate back up to 4% or so, and that just means we're going to have to raise the inflation target so we have more headroom. Or maybe, as discussed in the committee, in the panel earlier, maybe we need to rethink the whole business, go to sort of just a changes in growth rates things, or more extreme, let's go to zero inflation or a price level target or nominal GDP target. How do we adapt to this if this low real interest rate world keeps going? You want to start off with I guess I forgot which way I went last time. No, so it's Eric's turn to go first. So you can go with the higher inflation.
Well, I just
target.
had an intervention, so you could go to Jim.
Oh, okay.
You got to be flexible.
No rules.
Is that discretion or rules?
Pure discretion on this panel.
You want me to go?
Yeah,
all right. On R-star, the main failing of modern macroeconomics is the treatment of the trend. So the even estimated models will often say, we're just going to take averages over long periods of time. We're going to relate those to the balanced growth path that underlies the model, and then we're going to analyze a lot of fluctuations around that balanced growth path. But we know, both from looking at U.S. history and across the globe, that these trends do change over time. Now, in the model, if the trend changed, then that would change the behavior of everyone in the model, and so that would have to be taken into account. I've actually worked on models that are like that. They're not easy to work with. But from a policymaker perspective, we understand that these trends might be changing. One way to handle changes is to look at regime switching type models. I like those because they keep some level of stationarity in the system as opposed to a random walk. You can say that, let's say there's a high growth regime and there's a low growth regime. You might be switching very occasionally on 10 years at an expected length in a particular regime. And then but given the regime, everything behaves as it would, as if that was the balanced growth path forever. And then you can make monetary policy, but in order to make monetary policy in that environment, you have to know which regime you're in. So I think this is a good conceptual way to think about R-star. Eric just outlined some of the things that you might think are lower today and were higher in the past. Productivity growth is low today, was higher in the 1995 to 2005 period. Labor force growth was higher pre-crisis, has been lower post-crisis. Both those things would feed into this balanced growth path and therefore into the real interest rate associated with that path. In addition, you've got this longer run trend for increasing demand for safe assets that's been going on since the 1980s. So you had a period where there was relatively normal demand for safe assets. Today you have a situation where there's high demand for safe assets. That's pushing the safe yield down as well. I like this kind of framework. I think it keeps policymakers more on their toes about what's actually going on in the economy. and without disrupting the entire framework and saying that you can't do anything because you don't know what the state of the world is. I would be sympathetic to the idea that you could go with growth rate type policy rules that would do a better job of tracking where you were in this regime switching world, as opposed to simply assuming that you're always dealing with a constant balanced growth path. So I think I'll stop there on our start.
We had a very good session earlier in the conference about estimating R-star. It's not observable. There's a big standard error around any kind of equation that economists run, but I'd say that R-star in particular has a fairly large standard error. So I agree with the empirical work that it's quite uncertain, but I do think, given what we're seeing in productivity trends, which there's a lot of uncertainty about whether they'll continue or not, I don't think there's that much uncertainty about what the population trends are going to be, that the Fed doesn't get to pick productivity or population growth. And for those that want to make sure that we don't do asset purchases, they have to come up with an alternative of what they're going to do when we hit the zero lower bound. And so whether you think it's exactly 3% or not, it's not 5%. And I think it's pretty clear that it's not 5%, which means in most recessions it's going to be a problem. So I don't really think that the R-star estimation is really what's going to be driving whether or not we hit the zero lower bound, because even though there's a pretty big standard error, as I added up between what the inflation rate is, the population growth, and productivity, it seems very unlikely we're not going to hit the zero lower bound in most recessions. So I think it is important to try to estimate it. It's a good policy tool. I don't think that it's something, though, that hinges on whether or not we're going to be using balance sheets in the future.
You had wide-ranging questions, so let me pick up on sort of the different ways to do policy aspect of this. So I tend to favor, especially given where we've traveled from over the last 10 years, focusing on outcome-based policy, making sure that when we have a long-run strategy, which is well informed by modern macroeconomic theory and the natural rate going back to Milton Friedman, and having an inflation objective, which is price stability, good central banking, that we follow our strategy. And so we're focused on making sure we provide monetary and financial conditions to support full employment, that we state what we mean by full employment. So that's why we adjust our long-run statement every year, and that's a very natural thing to do. And we talk about what our inflation objective is and how it's symmetric. So 2% is not a ceiling, but that we're going to be have to go above 2% periodically and also be below that. So outcome-based is very important. Now, this isn't necessarily just discretionary, but it's not following any one particular rule all of the time. We need to use models, look at models, and we have to recognize, as Kevin said, we have to recognize when those models have obvious shortcomings. And so like the financial sector or the international sector, macroeconomics as a literature has not had to fit these models to match the data for the U.S. post-war experience, do a first approximation. Then other people come along and you add that. So when you're facing one of these more unusual circumstances, more like a tail risk, you need to be mindful of the fact that my analysis doesn't cover that, and we have other analyses that we have to add on to that and be very artful to. So it's very uncomfortable if you're accustomed and would like to have a nice single unified model. Doesn't exist. And I think that's a statement about the profession, not just central banks. And Stan gave a very good talk this morning where he mentioned that Don Cohn had said that the committee's been informed about Taylor rules and different alternatives going back as far as 95. So I think we have to be mindful of these tail risks, which means if you look at a tail risk, that means you need to be making a judgment about when the center of the distribution is not what you should be focusing on. And a rule is going to be focused on the center of the distribution. It tries to be robust against this, but if you're really going to be looking at tail risk, then
you need to be thinking about, now I need to do something a little bit different. I think that's what the Bernanke Fed did in response to the financial crisis, 10% unemployment, and the fact that inflation was not expected to get up to our objective anytime soon, and the rest of the world was slow to get there, but then they were further behind.
But I want to press you guys on this. If the zero bound is a problem, why not raise the inflation target to 3% so you got more headroom?
You want me to go?
I want whoever wants to say something go, and you could say no comment if you want to go on to the next question.
Okay, let me set you right on this. So
I don't like the idea, but
if you have higher inflation, you're distorting the economy all the time because of the higher inflation. So do you want to distort the economy every day so that on occasion you're able to conduct a little bit better stabilization policy? The literature has a clear answer to this, which is that the distortion caused by the everyday inflation is much bigger, order of magnitude bigger than the benefits of the stabilization policy. That's the received wisdom from the literature. You can do other models and stuff, but that's the way the debate should be stated. I don't think that the additional benefits from better stabilization policy would outweigh the day-to-day distortion that would come from the higher inflation target, and so I don't think that's a good trade-off. I also think that there are things you can do at the zero bound, including quantitative easing. I have been an advocate. It's not perfect, but there are some things that you can do, so it's not like you're out of ammunition when you're at the zero bound.
Well, I'll take the answer I like and move on. Because I also notice you guys are taking the productivity and thank goodness population growth as exogenous to the Fed. Whereas, of course, there's an alternative story that it's secular stagnation and the Fed should be doing more about it. And will you?
About what?
About productivity growth and labor force participation, productivity.
The thing that Solo said was the residual and the measure of our
Not my
ignorance.
theory. I just want to point out that you're going along with this. Okay, you're telling me to move on. Let's.
I'll keep asking. I'm okay.
Well, I'll get to ask it again in the next one. The lessons of the recent quiet period. Marty Eichenbaum put up a very interesting graph. The Fed, along with me and it seems everybody else, got forecast after forecast wrong, expecting the robust recovery that never came. Marty used it to say people are irrational expectors, but of course those were Fed forecasts. Maybe we're all irrational expectors too. The Phillips curve fell apart, the deflation spiral never came, growth is too low, but does that have anything to do with monetary policy? Or maybe we in Japan are just living the optimal quantity of money and growth is too low for real reasons? I mean, in the end, the Fed achieved its objectives: low inflation, maximum employment, at least that monetary policy can give you, and tiny interest rates. Maybe we should just have a big party. So what lessons do you see from this recent, surprisingly quiet period?
I'll start. So I agree with what Charlie highlighted early, that monetary policy should be focused on outcomes. So focusing on inflation and unemployment is something that we should definitely be focused on. You've just stated a whole bunch of things that can change over time, and in which there's a fair amount of uncertainty about what values they are at any particular point in time. It really kind of reiterates Stan's comments earlier about having a fixed policy rule, that if you think a lot of these relationships are uncertain and possibly changing, the last thing you want to do is tie yourself to a rule that might be wrong. So we do have an ability to monitor what's happening with inflation and unemployment. I think actually that should be the focus of congressional oversight, which is when we're missing on both those two variables, which they've highlighted, that is a discussion that we should really be having. But I'm not sure having Congress or the GAO determining what goes into the process of getting that outcome is actually particularly productive.
Okay, so the question is about the quiet zero lower bound, and I would take the main lesson from this era to be that, to paraphrase Friedman, near zero interest rates do not everywhere and always imply higher inflation. That's a puzzle, which I don't think even now the profession has come to grips with. It came out of left field. I don't think anyone expected that. And I would say most of the people in this room If I had told you 8 years ago where interest rates would be 8 years in the future, and I had told you what the size of the balance sheet and the monetary base would be, you would all have said, I bet inflation is high, or at least higher than target, and you would have been wrong. So that has been a shocking development from the point of view of received economic theory. At the St. Louis Fed, we're kind of overachievers on providing new ideas, so we provided two possibilities. Possibilities on what was going on or what might be going on. One is to bring out the Ben-Habib, Schmidt-Grohe, Uribe type analysis and think about the possibility that there's another steady state. That steady state is very robust across models because it only relies on the idea that there's a Fischer relation and a Taylor rule and a zero bound, most of which would be in any of our models. And maybe we're somehow getting stuck at that steady state, or you could interpret Japan as Ben-Habib et al. Did, as getting stuck at that steady state. I still think that that's a reasonable idea. I'm not sure that you really want to bring it in as the main focal point of monetary policy, but that's a reasonable idea about what has happened. And the other idea is neo-Fischerian, where if you just keep the interest rate low for a long time, or a permanent peg, as John Cochrane has, what eventually will happen is that the private sector expectations of inflation will come to be consistent with the very low nominal interest rate, and all that will happen is that inflation will come down. So that seems to be a good model for Japan as well. 20 years now with the policy rate below 50 basis points, and not too much on the horizon as far as changes. So after a while, private sector throws in the towel and says, well, I'm just going to expect the amount of inflation that's going to be consistent with that level of nominal interest rates, given that the real interest rate has to be determined by supply and demand conditions in that economy. So that, I'm not saying neo-Fischerian effects would, immediately dominate, but if you're going to move the policy rate for such a long period of time and keep it in the same place for such a long period of time, I can envision that it's private sector expectations which adapt, and as opposed to real output or other variables.
So one thing that I think Jim just sort of demonstrated quite well is that he's been willing to bring different views forward to the FOMC, different regimes, neo-Fischerian thinking, Schmidt-Grohe and Uribe, and I'll be honest, I don't always like it. The neo-Fischerian, we're gonna get inflation up by increasing interest rates is kind of counter, and so I'm not sure that's right, but I benefit from talking to my staff, having them educate me about things like that, and we sort of understand where those results come from, and I think we benefit from that. Either you buy into it or you kind of go, oh, that involves a slavish devotion to the Taylor rule all the way down into the deflationary spiral, through the gates of hell into Hades, all the way down and not stopping. Because if you stop, if you've got some threshold, then that's going to kill the transversality condition in the infinite limit, and then, okay, we don't have to think about that one anymore. But this is new. So it's a way of getting around groupthink that Kevin mentioned. I spent a lot of time talking about forward guidance and explicit thresholds as a means of trying to communicate to people who are skeptical, who always thought Marty's chart said the funds rate was going to be forecast to go back up, because it always has. And every time it was forecast to go back up, then you kind of go, we're not getting as much accommodation in place as we would like. So some way to demonstrate, with commitment, conditional, that we were going to be there as long as that was useful. And we had good committee discussions and all that. Eric has talked about financial stability issues and areas where we could run afoul given the exuberance, and if we ended up having to experience a period with the unemployment rate increases, those are risky propositions. So how far should we go with all of this? I think those are examples of the committee's benefiting from, and Stan mentioned this in his comments about different perspectives.
So I'm getting a sense that one response you might have to Kevin's worry about groupthink is that regional Federal Reserve banks are an excellent antidote to groupthink, and allow you to come up with alternative ideas to bring to Washington.
So let me just follow up on
All
that.
things in good measure.
Yeah. Let me just follow up on that. One of my favorite examples is actually Charlie Evans. So this is a mutual admiration society here. So, but you know, Charlie came with the idea of thresholds for policy. When he first gave the threshold speech, I didn't know what he was talking about, and I had never heard of it or even thought that way. He stayed at it for about a year or maybe more, and lo and behold, that entered into actual FOMC policy. Now, if the chair had gone out and said something about thresholds, you know, all hell would have broken loose. So I think there are some advantages to having the big committee in a world where, you know, it's been turned upside down. You do need new ideas to flow into the policy process, but you can't just spring them on global financial markets. You don't know what would happen. So there are, you know, there are advantages to this system that we have of allowing different viewpoints to be stated and to try out different ideas before they actually get into the full weight of policy decision making.
So let me move on to some issues that Kevin Warsh brought up in his talk. In public, the Fed talks a lot about point forecasts. What should we do assuming the economy continues to grow, inflation stays low? What's the path of normalization? It's sort of it's a very quiet scenario that we were talking about, and you know, with lots of do we raise 25 basis points first and then slowly squeeze down the balance sheet later and so forth. And there is a danger that this starts to feel like our congratulating ourselves on the great moderation in about 2006. The Fed puts banks through stress tests. Surely there are stress tests for monetary policy too. Now, you may not want to talk about this in public, but what scenarios keep you guys up at night? And what scenarios keeps the Fed up at night? What are the stress tests about? And what should the Fed do? How can we avoid being caught flat-footed once again when the next, surely somewhat unpredictable, but in retrospect, it looked predictable crisis comes? Do you worry about China blowing up, Euro blowing up, the US states blowing up, some sort of sovereign default, banks, student loans? I don't know. You know, what are you thinking about for where the next crisis might be, and what's the Fed going to do about it? In some sense, the Fed is, as long as inflation stays under 2%, that's not really your job anymore. And crisis management is much, much more of what the Fed's about. What keeps you up at night?
Well, I'll answer the first part about stress tests. I mean, with the Teal book, we do have different scenarios that we look at. And we look at scenarios where there are shocks that are unanticipated. For example, something happening in China or Europe that we didn't anticipate. And also just the uncertainty about economic relationships, that maybe we have a very different set of economic relationships than our standard models are telling us. And so the staff normally puts together 4 or 5 of those kind of scenarios. That is part of the discussion at each of the meetings. My own staff also goes through various scenarios that they think might be relevant to think about. Those scenarios change over time depending on geopolitical situation, depending on which economic relationships are breaking down. So I think we do think about these various scenarios. We tend to be focused on the modal forecast because it's much easier to explain the modal forecast than it is to explain standard errors, fan charts, and all the uncertainty that goes around these relationships. But these are things that we actually do around every meeting. And so when you look at, if you go back 5 years where you can actually see the Teal books, part of that discussion includes these various scenarios. And so, and each meeting, those scenarios do change as different economic data comes in. So I completely agree with you that we should be spending a lot of time thinking about what goes wrong. Those things change from over time, and that is something that we take into account when we have our deliberations.
I agree with Eric. We do scenarios. I think it's a good thing. We definitely look at, well, what if productivity comes in lower than we think, or what if various shocks hit from around the world, China, hard landing, things like that. But let me just elaborate a little bit. I don't think that what we do is sufficient, and so in that sense I would agree with Kevin Warsh's comments. If you think, here's how I think about robustness. So if you have a model where everything's going to return to the balanced growth path no matter what you do, and it's just a matter of how big the deviations are going to be, that's going to give you one view of the world and one view of the type of risk that you have to manage. But if you have a model that says most of the time you're on the balanced growth path, but sometimes all hell breaks loose and you go to a completely different state of the world, that gives you a very different picture of what you're trying to do. Because in that world, all you're trying to do is stay away from the edge of the cliff. You don't really care about the fluctuations around the balanced growth path. You just want to say, well, what types of policies are going to keep me from falling off the cliff? We don't have that kind of stuff. We don't talk in those terms except anecdotally, and it's not part of our models, and we don't work with models that have problems like that. So there are models in the literature. Probably the best known sequence of papers, there must be several hundred papers on Diamond Divig style bank runs, and then there, in those types of models, you're thinking about, well, what gets rid of the bad equilibrium? What keeps me from falling off the cliff? And that dominates the thinking in that literature. We don't have that for ordinary monetary policy. We treat the world as if it's quite a stable place. Even though you could be subject to pretty big shocks, you would still eventually come back to the balanced growth path that you started with. So I think we could do a better job on that dimension.
So, I mean, the kinds of things that, I worry about, and I've talked a lot about this, is basically, the risk that we end up back at the zero lower bound, or effective lower bound, however you want to describe this. Now, by the way, I'm not that optimistic about all of that digital payments currency where all of a sudden it becomes easy to sort of implement negative interest rates. I don't think those are very politically popular, and I'm not sure how that would be perceived, but the jury would be out on that. But I think that zero lower bound risks are really important. That is, what if inflation picks up? We know how to deal with inflation. We know how to raise rates. It's not good. We'd rather not be there. Volcker had to go through an awful lot, and it was extremely costly, and you wouldn't want to dissipate that credibility. But, we do know how to raise rates. But providing more accommodation when there are other factors that are not willing to provide that accommodation and the economy is suffering in a big way is very challenging. So that's why I think all of these issues are very important. Now, just to provide a little more balance, I mean, I have for the longest time sort of not given a lot of airtime to well, what if the low inflation risk does turn into a high inflation risk? Because frankly, it's been hard to imagine. But John, I've never quite understood all the ins and outs of the fiscal theory of the price level. I mean, there's a certain elegance to, that consolidated intertemporal budget constraint that you point out, but all of the ins and outs of when the active fiscal policy versus passive monetary policy, or that I always sort of go back to Leeper's very important paper in '91, and I've got a colleague, Leonardo Malozzi, who's sort of taken parts of that. So for a certain period of time, like maybe 8 quarters, 2 years, you have one where the fiscal policy becomes irresponsible. That's what kicks this all off. Deficits are so large that the real value of the debt has to go down. How's it going to do that? Well, it's going to go through a price increase. And you can get some of those large inflation rates, and that would be very challenging because those are times when monetary policy and fiscal policy are actively acting against each other, and the equilibrium is not really well laid out. That would be challenging. That puts you into sort of the realm that Jim, I think, is talking about, sort of outside of the normal approach.
Well, a global sovereign debt crisis would be challenging.
I just have one other thought that I wanted to hit on here, that the idea of this 84 models or 80 models, and that you should check what's going on with, in many different frameworks, and then try to, this was what Volker Wieland was talking about and John Taylor last night, that you should try to check against a wide variety of models and then see which things jump out at you as being consistent across all the models, and then which things are not. And that might be a good way to get better robustness in decision making. So I actually think that's quite a good idea, as opposed to what we do now, which is that we take really FRB US and then we run the different scenarios in FRB US. So now you're getting to a world with better IT, better computing. You could probably do the 84 models with, you know, not exactly the push of a button, but you could probably automate a lot of that and look at different scenarios and different models.
Quantity versus quality on models. I like it. So I'm going to ask you guys one last question, then we'll open it up. There is an elephant in the room. I won't ask you to comment on the Choice Act or other specifics, but clearly this is a moment when our country's rethinking the Fed's general structure, the nature of congressional oversight, your relations with the Treasury, and I welcome comments that you're willing to make on good or bad aspects of this. How should reporting be improved? You know, should it be more relative to rules or not? Do you favor the separation of monetary and policy and regulation? Does the Fed actually, should the Fed welcome some limitations on what it does, because limitations on actions are also limitations on responsibility? Should the Fed and Treasury come to a new agreement or accord and stop this business where the Treasury sells and then the Fed buys it? I mean, really, who is in charge of the maturity structure of the debt anyway? Should the Fed and Treasury routinely swap securities so that the Fed doesn't end up holding maturity and credit risk for long periods of time, as Charlie Plossard has suggested? Any structural issues of that sort you're willing to comment on?
So I'll take you had a long list there. So I'll take a couple of them, though. We've talked a little bit about rules. I want to emphasize that we look at rules. We spend a lot of time looking at rules, and we don't just look at one or two rules. We look at lots of rules. So I think it is very important to think about rules, think about why you're diverging, coming up with coherent explanations for why you're coming up with a different answer than a particular rule. That is very different than legislating a rule that you have to follow and gets audited by the GAO and results in congressional hearings. So I'm not in favor of legislation that would provide a rule or have us regularly provide a rule and then have to meet it for many of the reasons that Stan highlighted. So that aspect of the legislation I don't think is particularly productive. You mentioned supervision. I actually think that it's impossible to divorce monetary policy and supervisory policy. One of the reasons the financial crisis was such a serious problem was because financial institutions had such serious problems as well. And in fact, it's not at all unusual around the world that in instances where recessions coincide with severe problems in the financial sector, that they're much more severe, they take much longer to recover from, they have very broad implications for society in general. So I do think it's important that we understand those trade-offs. The topics came up in a couple of the questions earlier. I don't think we can divorce the supervisory responsibilities from the monetary policy responsibilities. I think we have to think about those two things and how they interact. And that is a very important aspect of what the Federal Reserve does, and I wouldn't want to see that change.
I'm going to mention some areas of Fed reform that I think that I've advocated in the past that I think we could actually do unilaterally without congressional action, and that I think would help alleviate some of the pressure that exists on the Fed. One thing I think that we could do is have press conference at every meeting, make each meeting ex ante identical, allow the committee to move at any juncture. Other central banks do this. We're one of the few that doesn't, and so I think this is important because the markets and the wider monetary policy community wants to hear from the chair, because the chair is the person that speaks for the committee and only the chair. And whatever you decided a month ago or 6 weeks ago, there has been intervening data, and there's been this and that has happened, and they want reassurance that you're still on track, or if you're adjusting slightly, they want to know that you're adjusting slightly. So, you know, my vision of communication is that communication should be more or less continuous, because developments in the economy are more or less a continuous process. If you had a model and it was continuous time and Brownian motion, the policymaker would be actually reacting in continuous time. So you want this idea of, continuous communication in epsilon amounts. So almost nothing is being said on any particular day, but because you're communicating all the time, markets are never surprised by the nature of the monetary policy. So I think press conferences would put us in a step in that direction. As it is now, between press conferences, we're at the mercy of the speaking schedule. Sometimes that doesn't work out also all that well, especially over the holiday period in the U.S. sometimes. So I think we could do more on that. We could also have a monetary policy report at a quarterly interval, which I think would be important to lay down a baseline for markets and for the policymakers and the committee itself. Here's what we're thinking in some very basic level about what's going to happen in the economy. You could compare notes with what private sector forecasters are saying. You could do this and that. And then everyone on the committee could give their own views relative to that baseline. So I think a monetary policy report could go a long way to improve Fed communications. In addition, I think that report then could include all kinds of reporting relative to monetary policy rules, because let's face it, John Taylor revolutionized how we do macro and monetary economics, and we already give long speeches in terms of monetary policy rules. Janet Yellen did it here herself at Stanford just recently, but this has been going on for years. We already talk in terms of monetary policy rules. We could put that into the report in the appropriate way, and this would give a benchmark to everybody about, okay, here's what this rule says, and here's some reasons why we're not doing exactly the prescription of that rule, or the committee's judgment was that that wasn't the right thing to do at this point. So I think you could get this idea of rules reporting going if you had this monetary policy report. So I think, now none of these things actually require legislation, so I think the Fed could actually take steps to go in this direction, and then we might not stress our lawmakers quite as much because they've got a lot of other things that they need to be doing.
So it's, extremely important for us to be accountable to, Congress and the American public, and to explain, what we're doing. I often think that as central bankers, we use language which always strikes me as a little bit arrogant. We need independent monetary policy. In a democracy, independence, what are you talking about? That's why accountability is really so important. So the chair goes up to Congress and testifies twice a year, scheduled, talks to the JEC. The taper tantrum started when Bernanke made some comments at a JEC testimony, and they go up other times when called upon. So I think that's appropriate. Because of accountability, it's natural for us to talk about communication. I mean, you could kind of wonder, why do you always have to talk about communication? It must be a sign that something's not right. But, how transparent are we? On the quarterly reports, let me just offer a minority opinion on a slightly different topic, which is the dot chart. Now, the dot chart is something that you either like it a lot or you do not like it. You say you don't understand it. And I think Kevin said that he thought that the dots were on top of each other. They might be on top of each other for, the end of the year when there's no action that we could do that's different than what we all know that we will do. But the dots, 1 year and then 2 years, it put on full display our disagreements. When somebody's got, like 8 increases over the next year or 2, and then somebody's got none. And people ought to want to know, why is that? And so I think that's one reason why people go out and explain that. I think, that they're very useful. And, another way, Charlie Plosser, I apologize I didn't ask you about this ahead of time, but I hope you would sort of agree. Charlie and I didn't always agree on the policy, over the next couple of years. But what's interesting is I'm pretty sure we might submit the same inflation forecast 2 or 3 years ahead, and probably the same unemployment, or that output growth would be at trend. What was different? The underlying assumption about the economy and what policy was needed, and the dots are what show that. So some people thought, I'm going to get there, but I'm going to get there because I'm fighting inflationary pressures, and others would say, I got to get inflation up. And so I think that's very informative, and that's part of
what we need to, have the public understand us.
Well,
Hope
thank
that
you.
was okay.
Unless you guys have some important thought you want to do, I'm going to go on. Okay, now I promised I'll reserve the first 3 questions for our ex-FOMC members, and then everybody else gets a chance. So, you guys got something you want to ask? Yes, Charlie, I knew you.
Those of you who've known me a long time know sometimes I can't keep my mouth shut, but I have a couple of questions. I want to follow up briefly on Charlie's last point, since there's a degree to which I take some responsibility for the dot plot and having it be there in the first place. And I spent a lot of speeches and time trying to explain to people what it meant and what it didn't mean. And I often use the example that Charlie just gave, which was that we may have the same forecast, but we have very different ways of getting there, or our underlying policy assumption. And partly what's incomplete about that is that readers of the dot plot or readers of the SEP can't match up those forecasts of the individual forecast with the person's dot. And many of us argued for a long time that printing the full matrix would be helpful in understanding some of these issues. That's just an aside. I actually want to I have 2 sorts of questions. One, I want to, both of them sort of were stimulated by different comments up there, but the first is about, kind of working in reverse order, is Jim's comment about monetary policy report and how we treat rules. At this conference, 3 years ago, I think, I gave a talk here where I said what the Fed ought to be doing in the first steps towards more systematic policy behavior is actually make the rules that the staff produce and the outcomes of the rules that they look at, make those part of a monetary policy report. And that has 2 benefits, I think. One is it's not adopting a specific rule, but it's forcing the communications of the committee to reveal its logic and thinking behind their decisions and explaining why they may deviate from, or where they lie in a range of rules would be helpful communication and revealing a strategy. And that talk, I think it was 3 years ago, must have been. But I'm glad Jim's talking about that. I hope the committee is continuing to do that, because I think that it would have been true by doing that, you could have headed off some of this stuff that the Congress is trying to dream up and being more proactive rather than defensive. And by the way, Mike Dotsey and I think Mike's Philadelphia is still doing it, is providing a sort of model report about how you might go about doing that. The other question I have, and this is probably more philosophical than anything, but I heard some differences up there, and this is the question about tail risks. This has come up a lot, and how central banks are naturally a worrisome lot. They wring their hands, and they're always worried about what can happen. And I suspect that's appropriate. It's kind of the nature of the beast. But I'm worried a little bit about our perhaps overstressing, unusual events and thinking about them as being sort of regular events. So, for example, when I was first learning macroeconomics and building models and thinking about models for the macroeconomy, a very common reaction you'd get in academic circles, well, that's great, that looks good, you've got everything working fine, we understand it, but it can't explain the Great Depression. Your model doesn't explain the Great Depression. If it can't explain the Great Depression, then I'm not interested in it. Well, we still don't understand the Great Depression. This is 80 years later, and people are still writing papers. There's revisionist views about what happened, why it happened, what policies worked, what policies didn't work. Leo Hanian's been on this sort of writing about different ways of thinking about what the effects of fiscal policy. So there's a lot we don't understand. I think there's a lot we don't understand about this crisis too. And I suspect 60 years from now, economists are still going to be speculating about what happened and why. So the point I want to make and try to ask is, do we get too focused on tail events and risk not using policies that may be demonstrably effective and useful in normal times, do we not do those because we're afraid of some tail event, or we think we understand a tail event that we really don't understand, and it gets us in the way of using good policies? And this was illustrated, I think, in Jim's point about inflation, when you asked him about, do we have a higher inflation? Well, the argument is, well, you know, yeah, we could have a higher inflation rate, and it might be better for some periods of time, but it would impose costs in all the normal times that we really don't need that. So making the trade-off for policies in their design, how do you think about that? Do you design policies or design mechanisms that solve only the big problems and then not worry about the normal problems, or vice versa? So I think it's an interesting kind of philosophical approach to thinking about the institution and policies. I'll stop
So
there.
I'm going to treat that as a statement, not a question, which, by the way, is welcome. And let me remind other people, say who you are. Unless you guys have something important to say. I want to let
You could collect a few questions, and then that's probably the most efficient way.
That's fine
nudge
with
me
me.
when you, or when you have something to say. That was a great statement. And
I can nudge you, speak up.
who else would like to ask something or say something? Yes.
It's Bob Heller. I heard a lot of willingness to engage in future open market operations, you know, QE type operations. And if I look around the world, the biggest risk I see out there, people talked about this black swans, is the insurance companies and especially the pension funds. A lot of them are underfunded by enormous amounts. And so how are you going to deal with that if you then want to do QE? And also in the same vein, if you have higher inflation, and some people have advocated that on this panel, a lot of these pension funds, they are fully indexed because they're public pension funds. So higher inflation is no way out of the dilemma that you're facing. So you've got a big black swan that you can actually see. What are you going to do about it?
I'll rule that a question.
Are we collecting things?
No, go ahead. I think you can answer that jointly with Charlie, too.
Well, let me combine the two, actually, because you're talking about a specific tail risk. And I actually do think that understanding what could cause problems for leveraged financial institutions is critically important. So insurance companies, banks, other types of financial intermediaries that could be significantly impacted. So Charlie made the argument for maybe we spend too much time on tail risk. I'd actually make the opposite argument, that it's really costly to have an unemployment rate at 10%. If I have an unemployment at 4.4 instead of 4.6, that's not a huge problem. But if I have a 10% unemployment rate, that is a huge problem. We're still suffering a decade after the last event. A lot of this discussion is tied to what happened with that event. So the problem with tail risk is that it has long tails, that it takes a long time to recover from that. And so I think we should always be asking ourselves, what are the kinds of problems that could generate those kind of very severe outcomes? I agree with your point that you don't want to construct a design for what kind of monetary policy you want to run just for bad outcomes. But recessions are not, in some respects, that big a tail risk. They happen they happen periodically enough. It's not like it's one every 50 years, it's one every 10 years or so. And so if you design a system that every time you hit a recession you're going to have a problem, that's probably not an ideal system. You should be thinking about the tail risk, trying to avoid it, and monetary policy may not be the right tool to try to avoid it. And I think some of the issues that were discussed relative to insurance companies, pension funds, they're probably regulatory rather than monetary policy approaches that are, I think, far more appropriate.
Let's go. Yes,
Well, the long-duration liability managers have obviously been challenged during the environment of low interest rates, life insurance companies, pensions, and it's very easy to go to some event and then sit down at dinner and find that your hosts have steered you towards sitting next to people like that, and then they kind of go, well, you know what, interest rates are low and you're really hurting them. Also, people who've done everything right, you know, throughout their life, the savers, and now all of a sudden interest rates are low. So, I mean, it is the case that
monetary policy has tried to reduce longer-term interest rates through portfolio balance effects in order to induce more risk-taking to get us, back towards better growth. But after the taper tantrum, term premium went up 100 basis points, and then we ended up, retracing that, and it wasn't because we expanded our asset purchases and all that, but worldwide interest rates have been falling. There are many factors at work, and many of the ones that George Shultz was talking about in terms of AI and 3D printing and how is that going to impact different segments of the population, and trend growth rates are lower in R star. So it's not just monetary policy, but monetary policy does live in that space during these periods where we're having to deal with this zero lower bound. That's why I say the zero lower bound is the risk that worries me the most, because I'm not sure that we could handle this. And if it's got the digital currency and you can all of a sudden get negative interest rate, well, that's only worse for that. So.
I think I got Dennis next.
Yeah.
Dennis Lockhart, formerly with the Atlanta Fed. I'll ask a fairly concrete question about, say, 2018 policy, and that is the relationship between tapering the balance sheet and rate increases. What's your current thinking as to how much accommodation will be removed through various scenarios of tapering the balance sheet versus increments of 25 basis point increases in the policy rate?
Well, you've only been retired a few weeks. You know the answer to this.
I remember the discussion, but I want to hear what you guys, maybe what happened last week.
I consulted the minutes of our March meeting carefully during the break just to make sure I understood, what we had all said, and it's pretty much what people have been saying in speeches, which is that, the committee is looking forward to the upward sloping funds rate path that I would say is pretty confidently in place. Fundamentals for the economy are good. And so, we're moving up towards this place that we have described as a committee when it is well underway that the rate increases have been taking place, and then we'll start adjusting the size of our balance sheet by not reinvesting the maturing proceeds coming off SOMA. The minutes indicated that many participants thought that this could begin before the end of this year, and also that there have been discussions about whether or not we would let the full amount mature and not be reinvested. I think that if you look at the monthly patterns, some months have larger maturities, and that could get in the way of some of the Treasury funding, and so just sort of smoothing that out is one possibility, but I'm not sure it's necessarily essential. So those are some of the issues that we've talked about.
Yeah, we adopted this regime switching view. We think we're in a very low real interest rate regime for a variety of reasons right now. We don't really see the factors affecting that regime switching very soon. So over the forecast horizon, we have a very low policy rate path. We're actually, our dots are definitely not sitting on top of everyone else's dots. I think if we went up 25 basis points or even 50 basis points, I don't think that would be the end of the world. But what I do object to is the idea that you have to go on this very long march up to 200 basis points or more over the next 2 years in order to keep unemployment low and inflation near target. I don't think that you have to do that given the current circumstances. So. And then if that's the view that you take, and you should, then the logical thing to do is to allow the rest of the yield curve to adjust normally and naturally, and so you'd want to take the pressure off of the longer term rates that's coming from the big balance sheet. And so I think you could allow the runoff of the balance sheet, and you could manage that, or you could let it all run off, and the chair will have to make a decision about that.
Okay, if I go on?
The committee hasn't made decisions on this, so I can only speak for myself. But I would say my preference would be that we start reducing the balance sheet relatively soon. and that we do it in a highly tapered way so it can serve in the background. So if it's highly tapered and it's going to be pretty gradual, then you can continue to focus on the federal funds rate as the primary target for meeting your inflation and unemployment objectives. And so that would be the two principles that I would be focused on: highly tapered, so it's not disruptive, so that's not the primary tool that you're relying on. And I wouldn't wait all that long. I have a slightly different view than Jim. We're at 4.4% unemployment. My own estimate for where full employment is 4.7, so we're already low. A lot of the private sector forecasts have GDP growth that's in excess of 2%. My own potential's at 1 3/4. That would imply continued pressure on labor markets. So I am a little worried that we need to take away the accommodation. We've been doing it very gradually by historical standards. I think that's appropriate. I want to continue to be doing it gradually, and the best way to do it gradually is to probably continue to do it so that we end up in a situation where we really are hitting both our dual mandate in terms of both inflation and employment.
Marty, you've been waiting patiently for a while.
I just wanted to raise a question about the interaction.
It's coming.
There's an important interaction between regulatory policy with respect to banks and many of the questions we've been talking about here, for example, the level of R-star or the size of the balance sheet. Let me give you two examples. One is because of liquidity coverage ratio and the way common equity tier 1 ratios are calculated, the weights for things like excess reserves, et cetera, obviously the demand for safe assets has gone through the roof and has arguably contributed a lot to the fall in interest rates that are related to R-star, right? It's not a one-to-one thing, but certainly they've contributed to an increase in the demand for safe assets. And so if we think about that trade-off, right, do we want to increase R-star a little bit by giving or cutting back on some of these bank regulatory ratios? That is to say, and you can actually see what's true in banks' portfolios. They've gone from 4% of holding treasury bills to something closer to 8 or 9%. So it's a very real and concrete thing. Another example of that is the size of the balance sheet. If you suck out all of these excess reserves, they have zero, they get no haircut in the liquidity coverage ratios. That's going to have a big impact on your ability to do so. So I think it's important as we go forward to not think of regular monetary policy and the size of the balance sheets as independent from our views about the right way to regulate. So any comments would be appreciated.
So, yeah, I mean, part of the regime idea is exactly that the demand for safe assets has increased, not just in recent years, but over the last 3 decades. The 1-year ex post real rate on a U.S. Treasury was in the 5% or more range in the mid-'80s. It's now, minus 1%. So you're down 600 basis points. It's a long-term trend. Doesn't look like it's turning around anytime soon. If you talk to people in financial markets, they say exactly what Marty Eichenbaum just said, is that, well, we're being required to hold these safe assets for various regulatory reasons. So the demand in some sense has skyrocketed, not just in the US, but worldwide. So what do you expect? The prices are going to be very high and the yields are going to be very low. But these are exactly the rates that are most relevant from a monetary policy perspective and are providing the baseline for a Taylor-type policy rule. So this is part of what we've taken on board in our regime view, in addition to lower productivity and lower labor force growth. And that's why we think we're in this low rate environment, at least for the over the forecast horizon. So I do think there is some interaction. I'm not sure I'd go so far as to say, well, you should back off of those kinds of requirements on the grounds that you want to have a higher R-star for monetary policy. I think monetary policy should probably adapt to the regulatory policy environment, and that's what we're trying to do.
I'll take a slightly different, so I completely agree with your fundamental point that when we think about monetary policy, we have to be thinking about how supervisory policy interacts with it. Liquidity requirements, though, I think are actually a critical component of how we think about what happened in the last crisis. So The dependence on wholesale funding was one of the reasons why investment banks had runs and why we had the kind of problem that we had during 2008. So I'm not sure the answer to safe assets is to allow the banks to once again get into a situation where they're potentially illiquid. I actually strongly believe that we need to focus on making sure that financial institutions are able to weather kind of liquidity shocks. And so I wouldn't do it by pulling back on the liquidity requirements. I do think that the Treasury has a way of actually providing more safe assets. So debt management, if it's worried about this consideration, could be issuing much more at the short end of the market to relieve some of these concerns. That seems much less costly, particularly for stress scenarios, than trying to change the liquidity requirements. So that would be my preference for how to address it. But I think your more general point, that whenever you think of system design for monetary policy, you have to take into account how regulatory requirements interact with monetary policy design, is a critically important feature of what we should think about.
What Marty brings up is that there's two sides of this balance sheet. There's the assets and the liabilities. We kind of got ourselves into talking about the assets, how you buying very long-term debt has affected long into the yield curve, and Marty brings us back to liabilities. Wait a minute, these vast quantity of reserves are actually now important, not just because of reserve requirements, but other things. Perhaps the other way out of the conundrum is the Fed gets rid of the longer-term assets in the MBSs, but keeps a large balance sheet funded by short-term treasuries, and that way you can keep the big reserves as well. No, says Charlie.
No, that was I'm trying to figure this out type of thing, because I was kind of thinking, well, we'd be taking the treasuries off the market, so they like those safe assets. Okay, but you're right, we'd be supplying also safe reserves and all of that. So that was my back and forth on that.
Did you want to say something?
Yeah, I don't think reserves are a perfect substitute for short-term treasuries. So I think the treasuries are more valuable in the marketplace.
Reserves are more valuable. Treasuries are more valuable than reserves. Yes, that's an interesting observation. Yeah. I've got 5 more questions lined up, but one of our rules is we end on time, and it is on time. So the 5 questioners, you'll just have to come back next year along with everybody else. Thank you, everyone, for coming. Thank our panelists. It's been great.